across every sector. So broad-based recovery is taking place at the start of this session as investors try to just pull back into some of those positions that were widely sold last week. One analyst saying to us this morning, actually, that the chief global economist at UBS, that effectively you don't want to be the last person out the door. That was the mentality last week, and you can see investors just waiting back in at these levels. Insurance stocks now at the bottom, just taking the place from chemicals, but still in the green, 0.6% firmer. Auto stocks, we were talking to a specialist on the credit side from Moody's this morning about this particular area. As you see, repricing on the demand side, and clearly a supply hit at this point, but also demand. As you hear those reports out of China, there's been no sales in some of these weeks that we've seen. Household goods, 1% firmer. Most stocks in the basket, particularly luxury, bouncing. Burberry right at the top, 4.5% gain. Banking stocks also rallying more than 1%. In the telco basket, we've got a bounce of about 1.5%, just outpacing industrials. Travel and leisure, we were talking this morning about IATA. They hit $1.5 billion at this stage to global airlines, but that may not take into account summer if we see a hit to the key travel period in the next couple of months. Technology stocks are racing ahead. Nokia getting a bounce on the news that there will be a new CEO. That is the second top performing stock in the basket. Basic resources, 2.2% high, every stock in the green. And you can see in oil and gas, after an incredibly rough week for spot prices last week, and what we've had from peak to trough, about 30+% pullback from the 52-week high. Oil and gas stocks this morning trying to bounce near on 3%. Let's take a look at those indices. Last week, we saw 3.5% coming off the stock Europe 600. And when in terms of the individual finish for markets, 3.1% down for the FTSE as we closed out the Friday session this morning, recovering half of those losses from Friday, about 3.5%. So it is a lift off, but it is tentative if you look at the percentage declines that we witnessed over the course of last week. And for me, it was the DAX. And this is the finish from Friday in contrast to the open that you're seeing across in these markets. The extent of those falls. So it'll be interesting to see how much the DAX claims in its first stages. We're up almost 2% on the French market, 5,413. The other markets, it is very cautious for the SMI in Switzerland. We've only got 0.1%. Firmer across on the Italian market, almost 1.8 on the IBEX. That's fairly decent. But in context, you can say we're not recovering even the Friday levels, let alone over the course of what we saw last week. Let's get into the data. And perhaps this is a precursor to what we may see in some of the other markets. Chinese factory activity suffered its sharpest fall on record in February as the coronavirus outbreak hit the world's second biggest economy. The private Asian manufacturing PMI slumped to 40.3. That is its lowest reading since the survey was first launched. This comes after official data this weekend also showed manufacturing activity shrank at its fastest pace ever. Let's push on and take a look at some of the big luxury names away from basic resources. We mentioned that Burberry was in the green, giving back some of those high levels, but still firm up by 3.1%. Hugo Boss, LVMH, all decent levels this morning. Auto stocks, and Moody's has warned global auto sales will slump by as much as 2.5% this year. Its outlook for the sector remains negative, given the disruptions of production demand from the virus, along with stricter emissions regulations. But every stock in the green at the start of the session. Volkswagen, though, just trying to open up this morning. Italy has announced a €3.6 billion stimulus package as it tries to limit the economic fallout from coronavirus. Economy Minister Roberto Gualtieri said the measures will include tax credits for companies that have suffered a 25% fall in revenues, as well as additional funds for the country's health service. Opposition lawmakers say the measures don't go far enough. The leader of the far-right Lega party, Matteo Salvini, has demanded at least €20 billion in additional spending. So far, some of the banking stocks, though, also bouncing with the rest of the European markets this morning. The coronavirus outbreak has seen Europe's tourism revenues decline by €1 billion per month since the virus first started. That is according to the EU's Internal Market Commissioner, Thierry Breton. Meanwhile, the International Air Transport Association, or IATA, says global airlines stand to lose $1.5 billion this year due to the outbreak. That is the amount they've tallied up so far. In terms of stocks in the basket, TUI Air bouncing 4%, very strong bounce back. It has been the airlines that have suffered a huge hit, and we saw in particular the likes of EasyJet, IAG, stocks that were under pressure in recent sessions. They are also getting a nudge higher, 1.1 on IAG, EasyJet 1.7%. But in context, we've seen huge declines, near on 20% for some of these stocks. Steve.
Karen, we got a new friend around the desk. And in fact, this gentleman who I introduced you to, I said, oh, it's all very informal. And he said, yeah, but I saw that interview you did last week with the inverse leverage single stock ETF chap. Not present. Anyway, Guy Thornwell is head of research UK and Europe at Pi Funds. Very good morning to you, sir. You've got a long history in the fund management industry. You have a lot of investors, primary New Zealand, Australasian based, but you're looking at small caps from this part of the world as well. So, first line I picked up from your copy, we are now in for a period of sustained uncertainty. That is going to be two-way volatility. It's not just going to be one way, is it, I guess?
Yeah, that's correct. I think about 3 weeks ago, we sent out a letter to all our investors outlining what we thought would be 3 different potential scenarios for the ongoing outbreak of the coronavirus. The first scenario was a brief period of uncertainty, followed by a recovery. The second scenario, which we think we're in now, is a prolonged period of uncertainty, as you mentioned, followed by then a recovery as well. And the third scenario would be a much more serious economic crisis, a global crisis, a true pandemic with wide-ranging and long-lasting economic consequences.
Markets don't seem to do two-way trade very well anymore. When they're hot, they're hot, and when they're low, they're low. And it just seemed the aggression of some of the moves we've seen over the last couple of years, it's all one-way stuff. So last week was just extraordinary. We don't need to tell our viewers just how extraordinary it was, because most of them were probably long asset, and it was probably quite painful as well. Do you think there is a market opportunity here and now amidst this longer-term period of opportunity, or would you just not go near it?
So what we are starting to do is we are starting to dip our toes into some of the holdings which we think have been oversold. We are definitely avoiding areas like travel and leisure, luxury goods. We had very low exposure to that already, and we think that there's further downside there. But certainly in some of our core holdings, we do think there are some good opportunities to increase our positions right now.
Final one from me before the others come involved. What are some of those core holdings that you're dipping your toe into?
So I think some of them would be in the software and IT services sectors. We don't think that there is any direct impact from the coronavirus in those areas. Some of those stocks, especially in smaller cap world, which where we're investing, have seen 20 to 30% price falls in the last week or two. And so we are certainly looking at increasing some of those areas. The other area would be any stocks in the industrial sectors, which we feel are good growth companies, but have potentially some supply chain disruptions due to what's happening in China and potentially in Europe. So some of those companies, we're speaking to the management teams, we're getting a read on whether there is a disruption, how long it might last, and in those cases where we feel comfortable, we're going to increase exposure.
Okay, great.
So is that, basically you're going to be looking for a growth versus value type tilt there in the fund? Would that be the continuation, or would you say more cyclical versus defensive, or is it just very stock specific at this point?
I think that Pi Funds has been a growth investor, and that's our strategy. So we focus mainly on smaller companies, and we are growth investors, so that will continue. We do see some more value emerging, because we do feel that valuations have been quite high over the last year or two, and we've had quite high cash levels relative to some of our peers. So I think it's still a focus on growth companies. It's just a question of, do we think that the short-term impact is going to go away soon, and therefore we're going to have an opportunity to increase exposure.
And you're not worried about the cash flow for some of these small and mid-cap companies? Because one of the things we've been trying to emphasise is corporate inequality. The big companies look as though they've got all the cash, they've been doing all the investment, and the small and mid-cap companies, from our analysis, look very exposed, Guy.
We absolutely are worried about quite a few companies, but those are not the ones we're investing in. So we definitely have a policy of buying companies usually with net cash. And so there are some companies in our portfolio where, from the working capital point of view, there could be an issue. So we're certainly doing the work and trying to avoid any problems there. But so overall, I think you're right. There will be some companies that have
quality first bias is still there.
Yeah, and that has been something that's been outperforming the market, but the levels of difference between quality, growth and value are very extreme at the moment, so we are cautious about that, hence our higher cash levels.
Brilliant. You're going to stay with us, Guy, for another chat, so that's great. Thank you very much indeed. That was easier than you thought it would be, wouldn't it? And we'll be back after a short break. But coming up on the show, a former Fed governor says the US central bank is, quote, bringing a knife to a gunfight. Wow.
listening to your team take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips on the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip
Follow
Bayless.
at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
Seasons. It's time for family gatherings, to stretch imaginations, to get together, or find some time alone. It's time for a Four Seasons sunroom that lets you have it all for less money than you thought. Right now, for a limited time, all Four Seasons sunrooms are up to 25% off, with no money down and no interest for 12 full months. Call Four Seasons today. Four Seasons. It's time. Thanks for watching. Now call the number on your screen and mention the special code TIME and receive exclusive additional savings on your new sunroom. Four Seasons. It's time.
Do you worry about going to the dentist? Well, relax. The Carefree Dental Card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree Dental Card information kit.
The American spirit, inherently competitive, always driven with a hunger, ambition, and an appetite to succeed. The pursuit of prosperity can be unpredictable and thrilling. From breakthroughs to breakdowns, the launches and the crashes. Perseverance is paramount. Knowledge essential.
Good morning, everybody. Welcome to Squawk Box here on CNBC.
That's what drives us. It's in our DNA to provide the information you need wherever you are to propel your dreams forward.
Welcome back, everybody. Obviously, this morning we've had a slew of information coming through, various officials commenting on how they think coronavirus is likely to impact economic activity. The IATA, the travel organization, talking about $1.5 billion impact to travel budgets. We're going to tell you about Lufthansa in just a moment, but let me get into the Spanish PMI data. Before we do that, the Spanish PMI February manufacturing number, 50.4. So it is above 50. It's a spike from the 48.5 that we saw back in January. And maybe some comfort here because these numbers clearly at this point won't reflect any nervousness around coronavirus particularly. So the indication is that the manufacturing sector in Spain returned to growth for February, according to the detail of the PMI data. So breaking an 8-month contraction, according to the write-up that we get from IHS. I did want to mention the information on Lufthansa at this point as well. The German airline company is announcing a number of changes to its route plans as a result of the coronavirus. I think the key issue is really flights between Munich and Hong Kong will be suspended between the 6th of March and the 24th of April. They will also be cancelling routes from Frankfurt and Munich to Seoul between March the 5th and April 24th. Flights to mainland China are suspended until the 24th of April, to Tehran until the 30th of April, and the group continues to suspend flights to China and Iran. They're also looking at reducing frequencies on the Swiss branded airline, that they own between to and from Florence, Milan, Rome and Venice until the end of April. And Austrian Airlines is reducing its flight program to Italy in March and April by 40%. Eurowings to reduce its flights to and from Venice, Bologna and Milan until the 8th of March. So very significant changes being announced by the Lufthansa Group around their short-haul European destinations and their long-haul flights out to Asia. I would suggest if you have bookings with Lufthansa, you might want to check your individual status on these.
Right, let us get back to our... I'm just going to note something else as well. 127 handle on the pound, by the way, everybody. 127.74. Pound continues to fall significantly now. It's just below the 130 level. Guy Thornwell is with us, Head of Research, UK and Europe, PI Funds as well. So you talked about sectors that have perhaps been overbanked to the downside that you liked as well. Again, unsavoury question, but I'm going to go there. Are there sectors that will do well out of this crisis?
There is one company which we are a holder of, which we think could do quite well, and actually the shares are up 5% on Friday. That's HelloFresh. So they provide meal kits to consumers at their home.
This is for people who can't buy ingredients themselves. Yeah?
Exactly. So well, we could see a scenario if we do get a worsening in Europe and the US, which are their main markets, where people don't want to go out shopping so much and they want to get more home delivery. This company could be a beneficiary of that. But I think overall, there are not that many sectors that are going to be on.
Can we throw Ocado into the mix too? I mean, there's been a communication to some of their customers to book in advance for delivery slots because you may see them sell out. So all delivery sites where there's essential products coming to the house, do we just start raking over some of those names? Amazon, obviously another big one too.
Yeah, exactly. I think that's a fair point. I mentioned HelloFresh, but there are certainly other companies in those sectors that could do well. And that is another reason why we think that some of the software IT companies are actually going to be fairly unscathed from a direct impact point of view.
So I just want to come back to the hedging strategy, because I think for our audience who are thinking about what to do with their own portfolio, it might be useful just to engage with that. 25 to 30% cash. How typical or untypical of your portfolio positioning would that be normally?
So historically, PI Funds has had quite high cash levels. It's around 20% or even a little bit higher over time. So we are a little bit above where we might historically be, but clearly significantly above peers. One thing to note is that we do invest mainly in smaller companies. When you have these kind of situations, you don't want to be selling all your small caps, because often they're quite hard to buy back when markets reverse because of liquidity reasons. So we feel that higher cash levels that we've had over time, but also employing market hedging is a better way than actually selling the small caps and trying to buy them back later.
And you do employ some derivative strategies here, short selling particular individual stocks, I would guess. How active are you at the moment on those strategies, given how volatile the market is and what the consequences could be if you get it wrong?
So when I'm saying market hedging, I'm only talking about using the indexes to hedge our portfolios. We don't actually sell short individual companies. We are long-only investors from that point of view. So at the moment, we have some protection on the rest of the portfolio in addition to the cash. So that means that our net equity position is around 40-50%.
We've got to push on to some stocks, and I want to show you Nokia as Rajiv Suri will step down as president and CEO of Nokia in September after more than a decade at the helm of the Finnish telecoms maker. Suri will be replaced by Pekka Lundmark, the current CEO of energy group Fortum. The Nokia's fourth quarter earnings beat expectations, but the company has warned profit will come under pressure as 5G costs ramp up. And keep in mind, this is one of those trends that many in the industry have been playing and wondered why Nokia stock hasn't caught more of a bid. To the other stock we're talking about this morning, ThyssenKrupp, the private equity consortium that won the bid to acquire ThyssenKrupp's elevators unit said it wants to spend billions of euros on expanding the business. The division was sold to PE giants Advent and Cinven for 17.2 billion euros. Credit Suisse has raised the German industrial group to outperform and upgraded its price target on the stock. That said, it's still down about 27% year to date. Kepler Cheuvreux has upgraded the European banking sector to neutral from underweight, saying the industry has priced in the impact from coronavirus. The broker is forecasting a negative hit of 18% on pre-tax profits from European banks. Meanwhile, Barclays has cut its price targets on HSBC and Standard Chartered, while RBC has also cut its price target on HSBC.
Great, isn't it? Cutting it after 18% lower in 3 months. I didn't say that, did I? Okay. Bank of Japan Governor Haruhiko Kuroda has pledged to offer sufficient liquidity in a bid to stabilise markets. Kuroda says stability will be ensured through asset purchases and appropriate market operations. What percentage do they own of the Japanese ETF market already?
So they've got a decent chunk.
They've got a decent chunk, haven't they? Yeah. How's that looking? Kuroda's statement has raised expectations of a coordinated global policy response. Well, we've definitely had global verbal stimulus today, no doubt about it. Better move on. US Federal Reserve Chairman Jerome Powell has pledged to act as appropriate to support the economy. Issuing a rare statement Friday afternoon, this side of the Atlantic anyway, Powell said that whilst the fundamentals to the economy remain strong, coronavirus poses evolving risks. The Fed chair's message came in response to growing expectations the central bank will cut interest rates at its upcoming meeting on March 17th and 18th. Stock futures on the Dow, but again, it's a very volatile time. So, speaking to CNBC, the former Federal Reserve Governor Kevin Warsh said the US central bank doesn't have enough ammunition in its fight against the economic fallout from the coronavirus.
It's likely to be a gunfight out there. When I look at the world's big central banks, not a lot of them have guns. Maybe the Fed has a bigger gun than everyone else, but the Fed probably has a knife. I wish they had a big, powerful gun coming into this moment. I wish they had more ammunition. I wish for the discussions we've had on this show over the last 9 years, they had prepared themselves for an exogenous shock.
All right, everybody. Look, I've told everyone earlier on, because I've got a big mouth like that, I've had some stimulus. I bought some heating oil. I live in the countryside, so I have to buy heating oil, not like you metropolitan ladies and gentlemen. And it's really cheap. I mean, really cheap compared to where it has been over the last couple of years as well. That's stimulus. That's real money that I haven't had to spend to buy heating oil as well. Does anyone here around the desk, Ian, think that central bank stimulus, apart from soothing the markets, those fickle markets, will actually make that much difference to the real economy compared with what we've already had with cheaper energy bills?
Yeah, the trouble is, Steve, that stimulus that you get from the lower oil prices, historically, it takes 18 months to come through.
It's right in my pocket, Ian.
Yeah.
Right in my pocket.
No, what's happening in your pocket? Your pocket has just got poorer. You've just spent some money. Now,
I bought fuel, which I need to have anyway. It's economic activity, which will happen anyway.
So that might actually help you, further out there.
Turn the thermostat down just because it's March.
And so, further out, when you've got to refinance that, when you've got to buy some more, you might have some more money in your pocket than you did have otherwise. Right. At the moment, you've got less money in your pocket than you did have. You just actually, unless you brought that forward. Now, so, the interest rate cuts will have a limited impact. What we've seen is that actually interest rate reductions have dissuaded people from doing investment, and they haven't really helped consumption because of, in our view, this inequality, that you've got between, companies that've got loads of cash that don't need it.
Guy, you want to come in on central banks and what they can and can't do?
I think I'm really with Ian on this. I think they're...
don't be, please. Lesson 101 of coming on at Squawk. Don't agree with me or Ian.
So I think that there is limited ammunition, but I think that there will be some kind of response, and I think that especially within a US presidential election year, President Trump will be leaning on the Federal Reserve.
You have a bearish lean anyway, judging by the numbers where your notes, where you talk about how you feel that we could already be in recession. One of the challenging things for us has been to square the circle on the data, because we continue to see good employment trends in developed markets, and on top of that, there's modest movement in salaries higher. And you do see some interesting tells, like the bank index in Europe rising, as perhaps investors begin to think that Europe may be seeing a re-acceleration in growth, at least before the coronavirus. Why the pessimism?
Well, I think we do feel we're quite long in the tooth in this bull market overall. So hence, coming into this coronavirus episode, we did have quite high cash levels, although those were actually lower than a year ago. So our belief right now is that, excluding the coronavirus, that Europe was certainly going to be starting to recover back towards trend growth as we got past Brexit and trade-related issues. So we think this, at the moment, we think this is a bump in the road, and that the economic cycle can go on a little bit further, but overall, room for central banks to stimulate is not very high.
Can I ask you very quickly what you're watching now for the next couple of weeks? What do you look for?
So I think the next couple of weeks, we're really focusing on the fundamentals of the companies we're invested in. We're speaking to management teams. We have calls set up for this week to find out about supply chain impacts, about working capital needs, so to make sure none of our holdings have any credit crunch issues.
Very nice to see you. Hope you'll come back and join us again.
Thank you.
Thank you. Guy Thornwell, who is Head of Research UK and Europe at Pi Funds. Ian, I hope you'll come back after the break.
Of course.
Right, coming up on the show, the Director General of the WHO urges the public and the markets to remain calm over the coronavirus outbreak. We'll bring you that exclusive interview with CNBC coming up next.
The CNBC app has new features just for you with real-time market data. And now you can watch CNBC live with a daily free preview. The CNBC app. Download it today.
My name is Melissa, and I am a new mother. So my husband and I had talked about getting life insurance with the expansion of our family. The folks at Policy Genius were very helpful, and we were able to apply together. By choosing Policy Genius, we were able to compare many different policies in a very short amount of time. In addition, we were able to get all of our questions answered. They were able to kind of navigate me to the right policy. My husband and I feel very much at ease now that we know that our family is taken care of.
Do you worry about going to the dentist? After all, a visit to the dentist can easily cost $2,000 or more. Well, relax. The Carefree Dental Card is now available in your area. Call now and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. Activate your card and you can start using it immediately. From exams and cleanings to more expensive procedures like crowns, dentures, even braces, they're all included with the Carefree Dental Card. Say you go to the dentist today without any card and your bill is, well, ouch. Wait a minute, let's try that again. You go to the dentist today and show your Carefree Dental Card, you save $525. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree Dental Card information kit. Call 1-800-997-2117 now.
The mission of Impossible Foods is to completely replace the use of animals in the food system by 2035. Animal agriculture occupies 50% of the land surface of Earth. Every product that we make using animals can be made more delicious, nutritious, and more affordable, and vastly better from an environmental standpoint by switching to plant-based food production. We have work on fish and dairy products. We can innovate. The cow can't innovate. This is the future of business. I watch CNBC.
A lot of people treat their finances like their health, and for some reason they don't want to peel back the curtain and know what's going on. Figure out all of your expenses. I'm paying this much in rent or mortgage. I'm paying this much in Netflix and cell phone and car insurance. Then you can figure out what income you need to supplement. Figuring out where every penny is going is crucial to you understanding your own financial health.
Invest in you. Ready, set, grow. CNBC and Acorns.
So European stocks finally, at the moment, having a green day with all sectors in positive territory, bouncing back after the worst week for markets since the financial crisis, as investors seem to be betting on expectations of coordinated central bank action. Chinese equities did close higher. They shrugged off a record contraction in mainland factory activity in February. And the Director General of the WHO tells CNBC markets need to be calm about the coronavirus outbreak.
The rationality doesn't push. We need to go back into the facts and the figures, and based on that we decide.
Times 10. Lufthansa cutting flights to Italy, South Korea and Hong Kong, whilst the International Air Transport Association says the endemic will slash global airline profits by $1.5 billion this year. And the French Finance Minister Bruno Le Maire says the outbreak will have a much bigger economic impact than previously thought, whilst Germany's economy minister warns they must not allow the virus to infect Europe's largest economy.
Everybody, so we are doing our best this morning to try and keep you in touch with the impact of various trends. One is the market move, one is the Obviously, behavior of coronavirus, one is the underlying direction of travel as far as the business community are heading in anyway. So we've got some flashes here coming out of the Hong Kong government. I just want to get to these because we also have some Hong Kong retail sales numbers. But the Hong Kong government says the business environment on retail trade has turned more austere lately. The government says the threat of the new coronavirus has brought inbound tourism almost to a standstill and caused severe disruptions to consumption-related activities. And clearly the latest news that we had from Lufthansa within the last hour suggesting that they are going to be closing down for a period some flights out to Hong Kong and China, not helping. January retail sales down 21.4% by value from a year earlier. January retail sales down 23% by volume from a year earlier. The government says it will closely monitor the situation and its repercussion on overall economic and employment market. Ian, the Hong Kong government has announced it's going to give $10,000 to every citizen. To what extent do those kind of measures help ameliorate the impact that we're talking about here?
I think that we were discussing, the relative impact of monetary policy versus fiscal policy. I think we're getting into a situation where lower interest rates have limited impact. They support markets. They don't seem to be supporting economic activity. And so fiscal action of this kind of nature is what we're likely to see more readily, I would imagine, going forward. So, I think at this stage it will have a much better impact.
I presume all central banks will be studying closely to see what ultimately helicopter money does look like, but somehow I don't think we're going to get the same cash bonanza here in the UK, Karen.
Right, that said, all eyes on what the ECB may do, and the markets have been repricing this morning, for instance, around whether there will be a move of 10 basis points, a cut from the ECB in April, and it has two meetings in April, one at the beginning of the month, one at the end of the month, but there's even more confidence too for some investors, more hawkish views out there around what we may see elsewhere. So just want to show you what we've got in terms of these European markets. We've got green splashing up on the boards. We're off some of the lows of the session that we've got on the stock Europe 600. We've got a bounce of 1.9%. The individual markets also recovering some of that lost territory from the Friday session. But don't forget, we were down more than 3% on the core markets. And if you just drill down to some of the individual ones, the FTSE up about 2.3%. So it's not recovering all of that 3% lost territory in terms of highs to low this year. The FTSE at one point was trading around 7,650. It drifted right down to 6,730. So there's still a huge gap in the point drop that we've had from the highs to lows so far this year on the European markets. When it comes to the rest of Europe, and I must say, as I'm talking, we've been seeing a lift off from some of these lower levels too on the stock Europe 600 in this window of time. Investors are still buying back some quarters of the market, but it's about 1.5% on the French market, about 1.25% on the DAX, still well off that 3+% drop we saw in some of these markets Friday. Let's dive into what we're seeing by sectors. The basic resources area of the market has been stronger from the outset, 2.6% roughly to the upside we're seeing this morning. We've got food and beverage outpacing, and oil and gas right at the top, 3% rally. And I think this part of the market, we're just seeing a little bit of appetite in the last couple of minutes. Again, investors picking up an area that has been very hard hit, about 30+% down on the peak to trough, the 52-week high that we saw versus some of the lows on the spot price in the last few sessions. So investors are wading back into this sector. Travel and leisure, I think a lot of people are still trying to work out what the overall hit will be to this sector and whether we've truly seen some of the red ink priced into quarters of this market. IATA had a go at it this year. Could be a $1.5 billion hit this year, but it also makes the caveat that they still don't know what's going to transpire over that key summer period. So there are some unknowns. Lufthansa this morning stripping out capacity. It flagged up to investors last week that short and medium haul flights would be impacted on capacity, and has been fleshing out where those flight cuts will come from this morning. Banks right at the bottom, but still high by 0.7%. Let's move into the individual sectors and stocks, what we've seen behind these boards this morning. This is the overall sectors, as you can see. Again, we've got green right across the boards, as you'd anticipate after such sharp selling that we saw in that Friday session. Just pointing out where we've got for those PMI levels, 2 out of China, and whether that's a precursor to what we're seeing here in Europe. We were just drilling down, I think, over the course of this show, what we're seeing in France. Key tourist attractions shut, but then behaviours across the rest of some of these capitals in Europe still semi-normal. Will that change in coming weeks? And if it does, will we start to mimic some of the numbers that we saw out of China, where we had the non-manufacturing PMI numbers at 29.6? That's right, 29.6. We often talk about a handle that's closer to a 50 mark. So is that a signalling function to what may transpire in Europe, or is that the worst of it? Will that be what China witnesses but will not transpire across Europe? Still open questions, I think, for many investors. Steve?
Yeah, for sure, Karen. Thank you. Right, the WHO Director General has told CNBC, this is the WHO Director General has told CNBC, what has he told us? He told us about coronavirus? No, he said markets should calm down. I find that extraordinary. Anyway, despite the organisation raising the global coronavirus alert to very high over the weekend, Hadley, viewers who've watched us an hour ago or 2 hours ago will wonder why I'm still saying the same thing. But I find it quite extraordinary that the WHO is now getting involved in market valuations, or have I misunderstood something?
It was interesting because this was a wide-ranging conversation. It was on the back of a UN humanitarian relief conference that was being hosted by an organization called KS Relief in Saudi Arabia. The basic premise of all of these folks gathered in this room, including the head of the World Food Program, the UN High Commissioner on Refugees, was that they were going to be talking about some of the big conflict areas, the most vulnerable populations. The Director General of the World Health Organization sitting on that stage, I had to ask him again and again, talk to me about coronavirus. What does this mean for the market? What does this mean for people globally when we talk about contagion, we talk about the spread, when we talk about mitigation? What is the, threshold for a pandemic? What are you looking for in terms of the data and the numbers to tell you that that's a point which the world has reached, and how worried should we be? I asked him about the market, as you say. He did weigh in on it. There was a lot of noise on that stage and in the audience, including a standing ovation for when they said, all of them on that stage essentially coming to the conclusion that this was all about a media hysteria. But I have some as well, not just about Iran and in terms of whether he can trust what's coming out of the Iranian government, whether he can trust what's coming out of the Chinese government in terms of facts and figures and data and what that tells him, but also specifically about Italy and how worried he is about the spread of the contagion of coronavirus throughout the rest of Europe. Listen in.
Europe may have some surprises like Italy. Other developed countries in Europe may have surprises. But at the same time, what's good about Europe is they have strong institutions, so they can revamp quickly and address it. So that's what I believe. But I was saying last week, it's not just about Italy. There could be surprises in other European countries in the neighborhood too. And prepare well. But even for Italy, since they have strong institutions, I know they will manage it as quickly as possible.
Does that mean potentially shutting borders? Are we there yet?
There are many ways. By the way, there are many strategies that we use, and the country should assess its situation, understand the risk, assess the risk, and then take measures proportionate to the risk. It's up to the country.
I thought that was really interesting there that the Director General was saying that this has to be up to every country. Now, I also asked him about U.S. President Donald Trump's response to this, that big press conference that we saw over the weekend from the White House, the fact that he put Mike Pence in charge there, and that now that we've seen, of course, over the last 24 hours, a second death in the United States from coronavirus. I said, is the United States doing enough? Do they have a handle on this situation? He said, it seems as if they're doing whatever they can. Really, it was just a bit of a word salad, in a sense, from this gentleman. Asking him so many questions, trying to get to the root of the answers. My takeaway, frankly, from all of that conversation and our sitting on that stage was that the World Health Organization at this point is still watching and waiting. But he did say to me that the window is narrowing when it comes to containing this virus, guys.
Hadley, excellent work. Thank you very much for that. Right, the French Finance Minister, Bruno Le Maire, has warned coronavirus will have a greater impact on the economy this year than originally forecast. It had expected a drop of 0.1%. Le Maire also warned that it's too early to provide fresh growth estimates, but said there would be a coordinated response from governments to boost the economy. Meanwhile, France's Louvre has shut its doors after staff voted to keep the museum closed over fears of the virus spreading in the popular tourist destination. Confirmed cases in the country hit 1:30 over the weekend. The closing was announced after Paris banned all indoor public gatherings of over 5,000 people following an exceptional Defence Council meeting chaired by President Macron. We have new Louvre flashes, Karen.
Yes, today is not the day to turn up for viewing either. The museum has kept its doors closed today while management employees discuss the coronavirus risks. That's according to witness reports. Charlotte, do you want to pop in on this because you've been tracking all that action in the capital in Paris?
Well, I think the Trinity Tech is still closed today. Tuesday is the day where museums are always closed, so that gives them a couple of days to try and sort things out for the rest of the week. But yes, it just shows the confusion there is in general after some of the instructions that came from the government, this cabinet meeting over the weekend, saying that these gatherings of more than 5,000 people in confined space would be banned. Some events have been closed, some trade fairs have been cancelled or postponed, and yet, so this created this sort of anxiety here that we see. And so these workers at the Louvre there yesterday saying they didn't want to be exposed to the virus. For visitors at the Louvre, is the museum's the most popular museum in the world. Is 1.6 million visitors last year. 75% of those are foreign. And so there's this concern here of what the measures should be, what the precautions should be. The government said that the measures they've put this weekend is try to slow the progression. That's on stage 2 on the scale of 3 of measures that the government can put. Stage 3 is pandemic, and stage 2 means they try to slow the progression of the epidemic. They try to reach the end of flu season. That's just coming to an end here. We've seen hospitals. We had strikes in hospitals because of emergency services very much under pressure. And so they try to gain time here to slow the progression, hope for flu season to be over so that hospital can deal with a potential crisis in the coming weeks if it was to happen. You also, an interesting fact here is that today is the first day of the official campaign for the municipal election starting in 2 weeks. You have 36,000 municipalities that will vote for their mayors in France across the country. It's a 2-round vote. And so the question will be whether, if the epidemic becomes worse, whether it will impact campaigning, town hall events, giving leaflets in markets, etc., and also just people going to voting booths, and whether they will be willing to go in small confined spaces like a voting booth to put their votes. So there's a lot of questions out there.
Voting booths on their own, aren't they? Last time I looked at a voting booth.
Yes,
you're not
but the
mixing.
services, the pen that you borrow, there's concerns. If in an environment where people are worried, you wonder whether there could be an impact. At the moment, it's 102
at the polls. Sometimes you're not just the only person turning up.
Absolutely.
There's a number of people who turn up in
130 cases at the moment. There's 9 critical, 2 dead, including one of them was a Chinese tourist that was visiting the country. And a lot of the hospital cases are actually for confinement rather than from the situation, the health situation. So there's a wait and see situation here in France. 130 cases, but we see that the events at the Louvre yesterday and today show that there's a sort of anxiety here and some worries on how to follow those rules that was given by the government over the weekend.
TF1's share price is up 4.3%. I wonder if that's, this stay-at-home story, Ian, that people seem to think matters. You think there's something in that?
Well, I think there's a hope here that we're looking at, that we're going to get some kind of stimulus. We're going to get people staying at home to some extent. So, the hope will be that you'll get some of that advertising. But I worry that, what we'll actually see is the small and medium-sized companies cutting back on advertising. And we've seen WPP has been one of the weaker stocks in the European markets over the last, few weeks. I worry that these advertising-driven business models, and that's some of the IT companies as well, will actually come under pressure here if we see these trends persist. And, I think the key thing is that we are definitely now in the European phase of the coronavirus. It was about Asia. Asia's now outperforming. It's now Europe that's at the heart of this, and we wait and see whether it goes to America.
Charlotte, thank you very much. Ian, thank you. Italian manufacturing activity declined for the 17th month running in February. at a slightly faster rate than the month before. According to the PMI survey data, the index edged down to 48.7 in February from 48.9 in January, slipping further below the 50 mark that separates growth from contraction. This data is a little bit weaker, I think, than the market was ultimately looking for. So 48.7, that's the number as far as Italy is concerned.
Excuse me. Let's talk more about the travel and leisure industry, which is at risk from coronavirus with travel restrictions and cancelled trips hitting the sector. Heath Terry, lead internet analyst from Goldman Sachs, joins us right now. Looking over some of your research, and it's back from the 30th of January, and you're already flagging up then that you expect to see slower bookings growth or margin pressure or potentially both. Now as coronavirus starts to spread across jurisdictions, what are you anticipating for some of the internet players that have crowded into the travel and leisure space in recent years?
Sure. Certainly the travel space, companies like Booking.com, Expedia, TripAdvisor have been hit hardest by this within internet. We have a whole spectrum, though. I mean, when you look across the space, companies like Amazon are seeing sort of a mixed benefit to their cloud business, less so to their retail business. Companies like Netflix, this is actually a bit of a positive. On the travel side specifically, though, we're seeing numbers that are suggesting down 30-40% in terms of bookings globally for some of those businesses just in the month of March. So it's going to be difficult.
I know there's been a lot of criticism for some of the websites, and Expedia very much so, around cancellation policies. The airlines, I think, have been very quick to try and waive some of the fees and charges, but Expedia, being a third party, effectively has to take whatever the airlines or the hotel groups are offering, then pass it on to the customer with their own charges. Right. Does this prompt a change down the track, a change to policy? Because there's been so many disgruntled travellers dealing with the website that down the track you think, well, maybe do they have to change this and reprice in the cost of cancellations themselves?
Well, I think it just shows the movement that you're seeing more broadly across the online travel space towards more direct bookings. The hotels themselves have been pushing really hard. You look at their advertising, it's all about moving direct, the loyalty programs that they have. Obviously, they're making this much easier to cancel for their loyalty program members than they are someone who books through a third party. And so I think there's probably a bit of that motivation behind them of using this as an opportunity to make the direct booking option more palatable to consumers in the future. Yeah.
So one of the questions I was just raising is, how dependent are we on the advertising side for the business models of these internet companies? Because that's the thing that I worry about, that, digital advertising is now more than 50% of total advertising, and it's very concentrated. But, is that just going to falter in a world where cash flow gets constrained by, for smaller mid-cap companies?
Yeah, this is going to ripple through everything, right? So to the extent that you're seeing lower bookings within travel, that's going to ripple through into the returns that those advertisers and what those advertisers are paying to companies like Google and Facebook and Twitter and Snap and the rest of them. So you will see an impact within the online advertising space. Digital advertising, though, is so incredibly concentrated within just Google and Facebook that impact is going to be pretty.
I think about 10 companies have 80% of the digital advertising spend. It's phenomenal.
Yeah, it really is. And so it will be relatively limited in terms of the impact that you see. And obviously, the companies themselves are so large and so equipped to be able to handle this.
What are going to be the winners here for you on this environment then, Heath?
To the extent that there are winners from this, it will be the companies, someone like a Netflix that benefits from people staying at home more. You're certainly not canceling your subscription now if you've stuck in the home, or you're not making those travel plans in the same way. The cloud computing companies will benefit from that to the extent that there's more traffic over systems from streaming, from gaming. So Amazon's AWS business will benefit.
But these still sound like the big companies rather than the small companies. There aren't more attractive little names that are around.
There will be some of the smaller companies that will benefit to the extent some of the smaller e-commerce companies like a Stitch Fix and an Etsy that will see a benefit from people shopping from their homes more. Those companies will benefit as well. Yeah.
Karen, you got some numbers for us?
Yes, just looking at the French IHS market February final manufacturing level at 49.8. So, of course, just under that key level of 50 still. And the question is whether this changes after Bruno Le Maire this morning, the French finance minister, saying it's too early to forecast what happens to economic growth at this point.
So we've had 3 pieces so far, and 2 of them have been under 50. Mm-hmm. Only the Spanish have managed to just climb over the line.
Okay. Round it up.
Rounded up.
Steve's been the positive one this morning.
I wouldn't do that normally. 49.8. Come on. Call it 50, can't we?
Why? We don't call some of the higher numbers lower numbers.
Heath, thanks so much for coming in. Good to see you this morning. Heath Terry, lead internet analyst for Goldman Sachs.
Bank of England says it's working closely with the UK Treasury and FCA as well as international partners to ensure all necessary steps are taken to protect financial and monetary stability over coronavirus. That's the big headline just hitting the wires. Plus, on this show coming up, Joe Biden gets a big win in South Carolina, but what does it mean ahead of the biggest day of the Democratic presidential race? We will discuss after the break.
Technology only matters if it makes a difference in the guest experience.
Fort Knox with John Fort. Subscribe to the podcast now.
Do you worry about going to the dentist? After all, a visit to the dentist can easily cost $2,000 or more. Well, relax. The Carefree Dental Card is now available in your area. Call now and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. Activate your card and you can start using it immediately. From exams and cleanings to more expensive procedures like crowns, dentures, even braces, they're all included with the Carefree Dental Card. Say you go to the dentist today without any card and your bill is, well, ouch. Wait a minute, let's try that again. You go to the dentist today and show your Carefree Dental Card, you save $525. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree Dental Card information kit. Call 1-800-997-2117 now.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school.
Call IU, then tell them your dream.
1-800-967-0542. 1-800-967-0542.
The American spirit. Inherently competitive, always driven with a hunger, ambition, and an appetite to succeed. The pursuit of prosperity can be unpredictable and thrilling. From breakthroughs to breakdowns, the launches and the crashes. Perseverance is paramount. Knowledge essential.
Good morning, everybody. Welcome to Squawk Box here on CNBC.
That's what drives us. It's in our DNA to provide the information you need wherever you are to propel your dreams forward.
Italian stocks now turning negative, and you can see in contrast to the green elsewhere on the charts, down 0.5%. It has had about 6 negative sessions, so this will be the 7th so far. Italian banks driving some of those losses. And I want to show you the airlines now because we did see some early interest, but given the changes to the capacity levels for Lufthansa, you've seen the sector turn tail. Lufthansa down 2.9%, but you can see outpaced by IAG, the owner of British Airways, to the downside. 4.7% slump now, right at the bottom of the stock ship 600.
Yeah, extraordinary. Okay, look, I can't round this one up. 48.0 is the German IHS market February final manufacturing PMI data. The flash figure was 47.8, so 48 in contraction territory. Can't get that one anywhere near 50, I'm afraid, even with my optimism.
You want a final word on this one, Ian?
Well, I think what we're seeing is, as our data is showing that, we are close to recession. And that's before coronavirus comes in. So you will see interest rates cut. You will see further stimulus. And, the markets will try and rally on it. But, if it gets sustained, then, we'll see that given back.
Do we still believe in the plunge protection team?
Yeah.
The plunge protection squad?
Yeah, they don't call it that, Jeff. They call something else, something secret.
I think we are running out of ammunition for that, and we're going to move from monetary to fiscal policy, and that's going to be one of the certainties of 2020.
Ian, great to see you. Well, hopefully we'll see more of you in 2020 as well. Ian Harnett, the investment strategist with us this morning from Absolute Strategy. He's a co-founder and chief investment strategist at that organisation. Thank you for joining us this Monday morning for Squawk Box. We'll be back to do it all over again tomorrow. Street Signs up after this.
The amount of people who'd love to go to space is enormous.
Opportunity. There's always opportunity. We have to innovate to win.
Think about the long term.
AI will change 100% of jobs.
Some people in negotiations, the best technique is to act half crazy.
The biggest names in business are on CNBC.
Stay tuned to get a free pan from Granite Stone. Stuck on eggs, burnt on batter. You can scrub and scrape, but you can't escape the nightmare of your sticky pans. Introducing the Granite Stone Pan, the all-new durable non-stick pan. No butter or oil needed. Watch, we melted down these sticky candies in Granite Stone, and it just doesn't stick. We cooked a half a dozen eggs, bacon, cheese, and tomato breakfast with no butter or oil, and it just doesn't stick. Look, caramels, chocolate, and cheese. Unreal for any other pan, but not for Granite Stone. It just doesn't stick. Granite Stone will be the last pan you'll ever need because it's pressed from a solid aluminum disc for even heat conduction. Then coated 3 times with our durable Granite Stone finish. Granite Stone is metal utensil safe and won't scratch. And talk about non-stick. This salmon cooked skin side down with no added butter or oil just doesn't stick. This steak is perfectly seared just like the pros. And because Granite Stone is oven rated to 500 degrees, we bake this upside down pan pizza to perfection, and it just doesn't stick. Fire Flambe Delicious Cherries Jubilee. Plus it's PFOA free and 100% dishwasher safe. Call or go online to get your Granite Stone pan for the special TV discount price of just $19.99. Granite Stone is so durable it comes with a 10-year warranty. And with every order, you're going to get a Granite Stone single-serve egg pan absolutely free. It's the perfect size for personalized eggs, omelets, or frittatas that slide right out. It makes the best bacon, egg, and cheese sandwich quick. Yours absolutely free. We'll even ship your entire order free. That's right, free shipping. You get it all, an incredible value. Here's how to order.
To order, call 1-800-652-6109. That's 1-800-652-6109 or order online at buygranitestone.com. That's 1-800-652-6109. Call now.
By choosing Policy Genius, we were able to compare many different policies in a very short amount of time. They were able to kind of navigate me to the right policy. My husband and I feel very much at ease now that we know that our family is taken care of.
Do you worry about going to the dentist? Well, relax. The Carefree Dental Card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree Dental Card information kit.
Right now on CNBC Make It. Think you've had tough job interviews? You've never met with Elon Musk, the CEO's brain teaser. You've had tough job interviews? You've never met with Elon Musk, the CEO's brain teaser.
CNBC, get yours.
Good morning. Welcome to Street Science. I'm Jemana Versace.
And I'm Juliana Tattlebaum. These are your headlines.
European stocks rally, bouncing back after the worst week for markets since the financial crisis, while U.S. futures point to a higher open as investors bet on expectations of coordinated central bank action.
Chinese equities close higher, shrugging off a record contraction in mainland factory activity in February. And the Director General of the WHO tells CNBC markets need to be calm about the coronavirus outbreak.
Irrationality doesn't help. We need to go back into the facts and the figures, and based on that we decide.
Lufthansa cuts flights to Italy, South Korea, and Hong Kong, while the International Air Transport Association says the endemic will slash global airline profits by $1.5 billion this year.
And French Finance Minister Bruno Le Maire says the outbreak will have a much bigger economic impact than previously thought, while Germany's economy minister warns they must not allow the virus to infect Europe's largest economy.
Good morning, everyone. Lots to get through today. But first, I just want to bring you some data we're getting out of the Eurozone. Probably a little bit outdated now, given everything that's going on with coronavirus. But the market February final manufacturing PMI numbers came in at 49.2, the final numbers. That is versus the flash estimate of 49.1. So slightly higher than the initial estimate for Eurozone final PMI numbers. Worth mentioning that, of course, none of this data would have taken into consideration any of the impact from coronavirus. Most of the data was collated before February the 21st. So that is why, even though there were signs that things were beginning to stabilize in the Eurozone, PMI manufacturing numbers certainly headed in the right direction. I have a feeling that the March numbers are going to be a lot worse than what we got for February right now. But that is the picture for the Eurozone manufacturing PMI numbers backward looking. But meanwhile, U.S. futures are called sharply higher today as investors welcome the prospect of a likely coordinated policy response by the world's central banks. This on the back of last week's steep market sell-off and Wall Street's worst week since 2008. The Fed Chairman Jerome Powell and the Bank of Japan's Haruhiko Kuroda have both pledged to step in and stabilize the markets if the coronavirus continues to rattle investors. So giving a little bit of comfort to investors this morning, but Juliana will give us a full breakdown of what's been going on in markets.
Well, European markets are on the mend this morning. The Stock 600 trading about 1.5% higher. This, of course, comes after the worst weekly performance for global markets since the global financial crisis. The Stock 600 ended about 12% lower. That was its worst performance since October 2008. Now, as Jumana just mentioned, central banks clearly in focus this morning as investors make bets around the stimulus we could see come through from central banks around the world. And overnight, we saw some data out of China overnight and over the weekend on the manufacturing activity there plunging. We saw record low factory output from China. So fueling stimulus bets from the Chinese economy, but also from the Fed, the ECB, and central banks more broadly. So putting it all together, we are seeing a bit of a rally this morning in European markets. We are seeing, though, a little bit of a pullback from the earlier highs seen this morning. So 1.59% is the number right now. Taking a look at the different regions, the DAX, the German index, up about 1.1%. We heard from Germany's economy minister earlier this morning warning they must not allow the virus to infect Europe's largest economy. So weighing in there from Germany. I want to take you over to Italy. The FTSE MIB down now about 0.6%. So a little bit of underperformance in Italy. And this comes after stimulus measures were announced this weekend. The Italian government injecting 3.6 billion euros worth of stimulus measures to try to mitigate the impact of the virus on the economy. But overall, green for the regions here in Europe. Let's take a look at the sectors, what the breakdown looks like. At one point, we did see green for every sector, but a little bit more of a mixed picture now. As you can see, we've got travel and leisure, autos, banks trading in the red. In the green, though, oil and gas, the clear outperformer this morning. That sector is up about 2.7%, and that comes alongside a bounce in Brent and WTI, nearly 4% higher for the oil price this morning. Jumana?
Excellent. Chinese factory activity suffered its sharpest fall on record in February as the coronavirus outbreak hit the world's second biggest economy. The private manufacturing PMI slumped to 40.3, its lowest reading since the survey was first launched. This comes after official data this weekend also showed manufacturing activity shrank at its fastest ever pace. But Chinese stock markets have shrugged off the dismal reading. Sherry joins us from Hong Kong for the greater China market reaction. And I've got to say, Sherry, I'm a little bit surprised to see how well Chinese markets are performing this morning, especially in light of the really dismal data we got. Manufacturing PMI at 35.7 over the weekend. The services numbers at 29.6. I didn't even realize we could get a 20 handle for these PMI numbers.
That's exactly what I was saying, all day this morning, Jomana. But I think it's really about what's going to happen post-COVID-19 that the market was really focusing on. And of course, as you guys were talking about at the top of the show, that central banks will be there for the markets and mainland Chinese bourses in particular, really take that kind of, message to their hearts, I guess, because we've got, of course, infrastructure names that really popping on a day like this, especially on the back of China's National Development Commission, talking about at this point speedy infrastructure project pickups. So I think really about China coming back to normalcy at some point and picking up the pieces, pursuing all these infrastructure projects, and that can perhaps explain the strong gains that we saw, especially when it comes to property names and some of the steel makers as well. I mean, when we're talking about some of the infrastructure names, especially in Shenzhen area, they were actually limit up for the day as well. And Chinese currency showed quite a bit of resilience as well, ending the day at a 3-week high against the greenback, popping by close to 3.5% against the greenback as well. In the meantime, as we are seeing the markets betting on, of course, this big pickup in economic activities down the road and stimulus hopes out there, there are, of course, the voices who are talking about how as China goes back to, factories, their offices, there could be some pickups in these coronavirus confirmed cases in China as well. So something that we need to bear in mind. On top of that, of course, the spillover effect in the regional economy as well as the global one. In the meantime, I do want to talk about Hong Kong specific story out just over the last hour or so. January retail sales numbers, while continuing to contract down at 21.4%. And of course, this is a city that's, not seeing a lot of shopping because, well, not just about coronavirus, but also because of the months-long anti-government protests. And of course, the month of February could actually see some worse numbers down the road. So something that we need to brace ourselves for. Guys, back to you.
And certainly something we're going to be discussing on street signs. In about 20 minutes' time, we will have a Hong Kong retail sales guest. Sherry, thank you for the breakdown of what's been going on in China. Now, the WHO Director General has told CNBC that markets should calm down, despite the organization raising the global coronavirus alert to very high over the weekend. He was speaking on stage in Riyadh, and Hadley joins us from Dubai with more. You conducted that interview. Hadley, one thing worth pointing out here is they stopped short of raising it to the level of pandemic. Do you think that is because they have an awareness that if they were to raise it to that level of pandemic, it would create some sort of extra panic or fear in the markets that he was just referring to as having overreacted so far?
It was a fascinating conversation and quite wide-ranging, Jemima, because at the end of the day, the sense I got from him was that he still doesn't know and that the data still does not suggest that we're on the threshold of that pandemic. But he did say to me that the window of containing this virus is narrowing and he is concerned about it. And he also spoke to the clarity, frankly, that he was getting from various nations, or potentially the lack of clarity when we talk about a country like Iran. The WHO is going to be sending a team into Iran to meet with officials there. There have been so many concerns, as you very well know, about reporting on Iran versus what the state media organization has been saying in terms of the number of deaths, in terms of the numbers of those infected. Lots of questions about what the Chinese knew, when they knew it, and whether or not they've been as forthcoming as they should have been. But I asked him also about the United States. Is U.S. President Donald Trump doing enough? Is he getting it right when it comes to coronavirus? He said, each state needs to be doing what they can. And he said, frankly, that about Italy as well. Listen in to what he said specifically about the markets.
No panic, no fear. We need to focus. Of course, concerns and worries are there. There should be, but we should be calm down and work. And stigma also should be avoided, which we are seeing and which is dangerous. This virus is everybody's enemy. Everybody's enemy. And as human beings, we should stand in unison. Discriminating and stigma is the worst. It's more dangerous than the virus itself. Thank you.
In terms of that, the WHO has said that this should be a reality check for governments globally. Do you believe that global financial markets need a reality check, given what you've just said about fear and panic?
Yes, global markets, it's to everybody, by the way. They should calm down and try to see the reality, as you said, reality check, facts, figures, and, decide based on that, rational. We need to continue to be rational. Irrationality doesn't help. We need to go back into the facts and the figures, and based on that we decide.
So the WHO Director General saying markets need a reality check. They need to focus on facts and figures. They need to be more rational. But at the same point, he was really unwilling and frankly unable to tell me, what's the threshold for a pandemic? At what point could there be a signal to the market that we've gotten past the point of no return? He also mentioned within that conversation and that framework again and again that we need to avoid media hysteria. On that stage as well, the head of the World Food Program, several members of the United Nations humanitarian refugee agencies, and folks that deal with humanitarian crises on a regular basis. And the sense that I got was a feeling of disgruntlement, frankly, that the coronavirus was taking so much attention off of things like the situation in Syria, Palestinian refugees, Syrian refugees, Burkina Faso, all these areas where they've been concentrating so heavily in terms of trying to get more donations from various governments. And, I said the issue at the end of the day is if you've got a coronavirus that's completely out of control, then governments are going to have to be supporting efforts to combat that virus. And it's going to take away funds and time and focus from the issues that you guys are here to talk about. And they said, yes, that is a big problem for us and something that it's deeply concerning given the amount of crises, frankly, facing the world today. Guys.
Yeah, no doubt, Hadley. But one thing as well that I want to point out is it looks like markets are actually listening to the WHO Director General today because everything is trading up in the green. So things for the time being are looking like they're settling down.
We'll take what we can get.
Exactly. Thank you, Hadley, for the coverage out of the Middle East. All right, let's bring in David Owen, the Chief European Economist from Jefferies International. David, look, all of this is coming at a time where the world was already set back by trade wars, that we were just beginning to turn a new page. It looked like there were some green shoots emerging, stabilization of data, boom, coronavirus. We've seen the numbers of the weekend in China, and if that's just a little taste of what's to come for Europe, feels like we are on the precipice of a recession here, aren't we?
Well, I think we can go back and we look at history and the history of pandemics. This is not yet as you described, not actually a pandemic as defined, but pandemics, typically the hit to the economy is very localized, very focused. It happens only over 1 to 2 quarters, and then you get a recovery. So we're seeing the effects coming through now in the Chinese data. Obviously, we expect to see more impact coming through in Europe in Q2, and that's where the hit will occur. So is GDP going to be down 1% in the second quarter? Is the potential hit going to be higher than that? What we also know from history is if they do widespread school closures, people stop moving around, then obviously the hit is greater. What policymakers need to do is provide liquidity, cash injection in this period to get through this hump, of this cash-strapped companies running out of cash and so forth. So that's where I think the focus needs to be. And obviously over the weekend we had the Italians coming out with a package. Obviously companies may need debt relief, may need tax relief and so forth. And the banking sector may need help. But once we get through the second quarter, we're assuming that growth actually rebounds. So that's the history of pandemics over the centuries.
Let's just dive a little bit deeper into the different policy options here. You mentioned the Italian stimulus package that came through. Hong Kong is also pushing ahead with their helicopter money, essentially. How do you think about the efficacy of targeted fiscal measures versus monetary easing measures targeted perhaps more at liquidity in terms of the ability to deal with this virus?
At the end of the day, it's a government decision to provide cash. It's not a central bank decision. So with the European Central Bank, for example, if they feel that Italian small, medium-sized enterprises need cash, then obviously that's a fiscal decision. That's where it has to be. In terms of the Fed, we're pretty convinced they're going to cut rates by 50 bips. It's a question of when they do it. We've got a keynote speech from Mark Carney on Thursday. I'm assuming that he wasn't hoping to actually speak about this, but obviously it will come up probably in the Q&A. As I say, we have to look through the current, widespread worries quite rationally. But at the end of the day, I think the hit will be seen only in 1 quarter, and that's what policymakers will be banking on, that we get through it, and then we get a recovery occurring in the second half of this year.
David, there's even talk of the Fed going as much as 50 basis points in the March meeting. There's some chatter about them going that far, cutting rates that aggressively.
Warren McCarthy was talking about 50 bits before the meeting potentially.
Right, but my question to you is the pushback that we get from that is the perception in the market is that central banks are not as efficient, to Juliana's point, at dealing with supply shocks as they are at dealing with demand shocks. So far, the reaction and the effect has been limited to supply. We don't know whether or not it's going to start affecting demand. So that is the calculus that the Fed has to make.
Absolutely.
In your view,
Absolutely.
Does that mean that they should go early, or should they wait until they get a little bit more evidence?
Well, I think the US is different to Europe. So when I think about the US, I mean, obviously people are much more obsessed in the US about the level of the stock market, and it matters much more for corporates. When they look at Europe, particularly looking at SMEs in countries like Italy, the stock market valuation of large companies isn't really the issue. The issue is having a cash to actually supply the business and keep the business functioning through this period. At the end of the day, I can understand why the Fed would cut rates, maybe be more discussion about quantitative easing. The ECB may think about doing more QE. Obviously, the ECB meeting, by the way, happens in March before the Fed, so that again is interesting. But I think most of most of the discussion at the central bank level will be more about liquidity needs rather than QE itself.
Right.
But we're obviously the market wants to see QE, so that's again what we saw over the weekend with the Bank of Japan, and that's also buoyed markets this morning.
Yeah.
But I think important to recognise it's normally a 1 to 2 quarter hit to GDP. The important thing is we have to get cash-strapped companies through this period.
All right, David, really appreciate your thoughts. You do stay with us, and more conversation coming up. David Owen, Chief European Economist, Jefferies International. Coming up on the show, as we were just discussing, Italy unveils a stimulus package to mitigate the outbreak of coronavirus. We'll discuss the details after the break.
All right, we got to stop here first.
From smarter ATMs to after-hours video tellers, Comcast Business is connecting thousands of banks to technology that turns everyday transactions into extraordinary experiences.
Hi there. How are you? Do you have any lollipops in there? No, sorry.
We're helping all kinds of businesses go beyond customer expectations. How can we help you?
I used to be a little cranky. Dealing with our finances really haunted me. Thankfully, I've got QuickBooks, and the live bookkeeper is helping customize it for our business.
You're all set up.
Great!
Get set up right with a live bookkeeper with Intuit QuickBooks.
You may know Viking for our award-winning river cruises. But did you know Viking is also the best at sea? Voted by readers of Travel and Leisure 4 years in a row. Discover fascinating destinations and enriching activities on our elegant ocean ships. Designed for just 930 like-minded travelers. Viking, exploring the world in comfort.
Selling on Poshmark is crazy simple. All you have to do is post a picture, add a description, add a price, and you're pretty much good to go. Right now I'm selling Air Jordans and Nikes and Adidas, anything really performance related or style related.
Download the free Poshmark app now.
Does hair loss run in your family? Are you losing your hair?
You can now treat hair loss at home in just 6 minutes a day with a laser light therapy that's been clinically proven to treat hair loss and regrow thicker, healthier hair. It's called the Capillus Laser Cap.
Laser therapy is an FDA-cleared treatment for hair loss. What laser therapy does, it reboots that blood supply. It reestablishes blood flow, oxygenation. It's a very effective treatment for hair loss.
Using the cap is very simple. I sit pretty much right here, watch TV, and I have it on. It's completely comfortable. You forget you have it on.
I just put it on when I watch the TV, and I got my hair back.
I feel like it truly has changed the way I see myself.
If you notice it, do something about it. Don't wait, because the longer you wait, the worse it can get.
Get the results you want or get your money back. Payment plans are available.
Call 1-888-474-0056 today or go to trycapillus.com.
Will the bears continue their run, or will there be signs for turnaround in the turmoil? The read on early trading signals for investors. Squawk on the Street, 9 a.m. Eastern today. Watch or listen live on the CNBC app.
Welcome back to Street Signs. Some news out of North Korea, actually, this morning. North Korea has said that they will charter one flight from Pyongyang to Russia's Vladivostok to allow foreigners, they've just said foreigners, to leave amid coronavirus outbreak. This is according to Chinese state TV. The flight for foreigners will depart from Pyongyang on March the 6th and will consist of staff from international agencies and diplomatic missions. So that is word out from North Korea doing their bit for coronavirus. But this is obviously a couple of hours after doing multiple missile launches a few hours ago. So we'll keep an eye on the geopolitical developments out of North Korea as well. Now, switching back to Europe, Italy has announced a 3.6 billion euro stimulus package as it tries to limit the economic fallout from coronavirus. The economy minister, Roberto Gualtieri, said the measures will include tax credits for companies that have suffered a 25% fall in revenues, as well as additional funds for the country's health service. Opposition lawmakers say the measures don't go far enough. The leader of the far-right League Party, Matteo Salvini, has demanded at least 20 billion euros in additional spending. As ever, the story has become politicized. Claudia joins us with more from Milan. Claudia, tell us more about this package that was unveiled, Italy being one of the first Eurozone countries to actually come out with a formal coronavirus stimulus package.
Well, clearly this package, it's too early to tell if it will be enough, but it is, as you were saying, 3.6 billion euros worth of stimulus, in part with tax credits for companies, as you were saying, lose at least 25% of their revenues. Also further tax cuts, in addition to already the suspensions that were made to mortgage payments and other decisions that had been made to step in to sustain at least the red zone, as well as, of course, extra cash for the health system, because that is where the money really needs to go in order to help prevent the limit of help that these the health system can give. Remember, let's talk numbers now. We've gone from 152 cases 7 days ago to 1,577. 83 people have healed, and 34 have lost their lives. Keep in mind that 40% of the people that do contract the coronavirus end up needing some medical help. And that's what the authorities are trying to step in to solve, is not so much the risk of getting the virus as much as the fact that if you do get it, there is a higher chance that you will need medical help. And so in order to try and curb the number of people having to access these hospital facilities, they are trying to limit people's movement to try and reduce the number of contagions. So once again this week, this is the first Monday morning, second Monday of these measures that limit people's movement that is in place. And as you can see, of course, our market has been affected by that. The Italian market is once again in negative territory, with the banks taking the hardest hit. But, you know, it's too early to tell whether that package will be enough. Clearly, the situation here is difficult, but people seem to be trying to react with calm and trying to work even from home if they're not allowed to go into their offices. Back to you for now.
Claudia, thank you so much for the latest from Milan. Now shifting to France, the Louvre has shut its doors after staff voted to keep the museum closed over fears of the virus spreading in the popular tourist location. Confirmed cases in the country hit 130 over the weekend. The closing was announced after Paris banned all indoor public gatherings of over 5,000 people following an exceptional defense council meeting chaired by President Macron himself.
And the French finance minister Bruno Le Maire has warned coronavirus will have a greater impact on the economy this year than originally forecast. It had expected a drop of 0.1%. Le Maire also warned that it is too early to provide fresh growth estimates, but said there would be a coordinated response from governments to boost the economy. Charlotte, you've been following the developments in France. Talk us through some of the measures that were announced by France over the weekend as well.
Yeah, well, as mentioned, there was this cabinet meeting over the weekend, and they announced these measures of banning public gatherings of 5,000 people and more in confined spaces. The Foreign Affairs Ministry advised French people to not travel abroad if if possible and avoid that. So a few events have been cancelled. You had the half marathon in Paris that was meant to be held this weekend, 44,000 runners. That's been cancelled. The Paris Book Fair, which is the largest literary event in the country, has been cancelled last night. You had the real estate, a big trade fair in Cannes that has 25,000 visitors a year later in March, also has been cancelled. So you have all these things have been happening. At the same time, Paris Fashion Week is still going as usual. A few side events have been cancelled, but we saw in Milan, Paris Fashion Week very much being packed. Armani having his show in an empty room, while in Paris it's still going as usual. So it's a bit of a weird...
Go on.
Exactly. So it's a bit of a weird mixed signal here, a bit of confusion. And we see the event at the Louvre reflecting this. Closed yesterday. It looks like today must still be closed. Tomorrow museums are closed on Tuesdays in France.
Yeah.
So there's a bit of a confusion here on the public and a bit of anxiety.
Well, let's bring back in David, because I thought it was interesting what the mayor was saying about the possibility for a global or at least a coordinated government response here. Do you think we're getting closer to the prospect of years on helicopter money?
Well, that's eventually where we could go, but the first thing will be fiscal response. I mean, it's one thing actually just putting cash into the accounts of cash-strapped companies, ensuring the banking system is in a very healthy position. It's not entirely, sort of helicopter money raining over an economy. So I think the first thing is much more of a fiscal response. I mean, what the Italians have done over the weekend is exceptionally sensible, but it's a step only in that direction. So if you think about the hit to GDP in the second quarter for much of Europe, it could be 1%. Worst case scenario, 5%. So that's what history tells you before GDP recovers in the second half. So 0.2% of GDP is pretty helpful, but it's not enough. And it needs to be coordinated. So we need much more of a coordinated response by governments. And I'm sure Christine Lagarde will be making that quite clear around finance ministries.
Just very quickly, are you expecting anything then out of this ECB meeting on the stimulus front?
Well, it's quite possible. She has to talk about liquidity, and she has to talk about, as I say, they can stretch the envelope and buy bank bonds. That's possible. But in terms of, other measures, I mean, it's more about fiscal policy, I think.
Yeah, as ever. David, thank you very much for joining us. David Owen, the Chief European Economist from Jefferies International. Charlotte as well. Thank you for breaking down what's happening in France. Stay with us, because also coming up on the show, we're going to talk Hong Kong retail sales, which have dropped for a 12th month in a row.
Nothing comes easily. That's what happens in golf and in life. I'm very fortunate that I can lean on people, and that for me is what teamwork's all about. You can't do everything yourself. You need someone to guide you and help you make those tough decisions. That's Morgan Stanley. They're industry leaders, but the most important thing is they want to do it the right way. I'm really excited to be part of the Morgan Stanley team. I'm Justin Rose. We are Morgan Stanley.
Uh-oh, there you go. Slow slicing fruits, veggies, and those stinky onions that bring you to tears. But not anymore. Introducing NutriChopper, the compact handheld speed slicer that cuts up to 10 times quicker than a knife. Watch. You can have one slice or 10 perfect slices at once. Amazing! You can just julienne, or you can bundle slice julienne sticks at lightning speed. With NutriChopper, you can slice the entire onion, or mince a mound of onions and never have time for tears. Why slice a single apple wedge when you can wedge it all in one snap? NutriChopper comes with the razor-sharp interchangeable stainless steel blades you need to make all of the cuts you want, and all incredibly quick. Chop thick slices, chop thin slices, chop cubes, chop sticks, and wedge whole fruits and vegetables in just 1 second. Slice it and cook it right in the pan, right on your stove. Chop and slice right into the pot for a family-sized stew with no mess. Snap and slice a fruit salad for the kids right into the bowl in seconds. Slice up a healthy salad for a quick and easy meal on the go. Cube meats and cheeses quick, in a snap. And NutriChopper comes with a perfect portion container and fresh-keeping lid, so you can slice it, seal it, and store it all in one. To clean, simply rinse or rack it in the dishwasher. Then lock it to store it safely in a drawer. And now the NutriChopper with the thin slice, thick slice, wedge, and cube blades, and the slice and store container and lid, a value of over $40, is yours for just $19.99. But wait! Order now and we'll even pay the shipping for you. You get the complete NutriChopper set with blades and container with lids, all for just $19.99 with free shipping. Here's how to order.
To order, call 1-800-257-9942 or go online at NutriChopper.com. That's 1-800-257-9942 or go to NutriChopper.com. Order now.
She worked with Travis Bass, Ricky Williams, Lex Hilliard, and Dennis Rodman.
Pro sports superfan scams athletes to score millions. All new American Greed tonight, 10 Eastern. CNBC. Get yours.
Welcome back to Street Signs. I'm Juliana Tattlebaum.
And I'm Jemima Bersecci, and these are your headlines.
European stocks rally, bouncing back after the worst week for markets since the financial crisis, while U.S. futures point to a higher open as investors bet on expectations of coordinated central bank action.
Chinese equities close higher, shrugging off a record contraction in mainland factory activity in February, and the Director General of the WHO tells CNBC markets need to be calm about the coronavirus outbreak.
Irrationality doesn't help. We need to go back into the facts and the figures, and based on that we decide.
Lufthansa cuts flights to Italy, South Korea, and Hong Kong, while the International Air Transport Association says the endemic will slash global airline profits by $1.5 billion this year.
And French Finance Minister Bruno Le Maire says the outbreak will have a much bigger economic impact than previously thought, while Germany's economy minister warns they must not allow the virus to, quote, infect Europe's largest economy.
Well, we've got the UK PMI numbers now just coming through. We had the Eurozone ones earlier this morning. UK factories feeling the effects of the coronavirus spread. The number came in for the PMI at 51.7. That was from the no change level of 50 in January. So slightly higher than we saw the month previous. That's the highest since April, but slightly weaker than the flash reading of 51.9. So slightly weaker than the initial expectation, but still coming in at 51.7. That is healthy in expansionary territory. But of course, bear in mind, this is for the month of February, so somewhat backward looking when we consider the latest developments. Jemima?
Similar situation for those Eurozone PMI numbers we had earlier as well. All right, let's take a look at how European markets are faring this morning. You can see it is almost a full suite of green. Sharp contrast with the price action that we had last week. Friday, we had Stock 600 end the day 3.5 percentage points lower for the week. Most of these indices were down about 12% as well. So yes, we are regaining ground this morning, but not fully recuperating the dramatic losses that these equity markets had last week. FTSE 100, you can see up 2.3%. Doing quite nicely, up 150 points. Just moving away from coronavirus for 1 second, worth bearing in mind that the EU and UK are beginning official talks about the future trading relationship this week. So there are about 100 UK lawmakers heading to Brussels today. Negotiations will start and continue until Thursday. So that's something to keep an eye on as well from a political perspective. Xetra DAX in Germany, we have up about 80 points. Was doing better earlier, has paired some of those gains in the past half an hour or so, but still a little bit of green on the boards here. CAC 40 up 1.3%. We've been talking about some of the measures announced by the French government over the weekend to help deal with the containment of coronavirus, including banning meetings of more than 5,000 people and various other measures as well. But the big one that we were looking at is the FTSE MIB, the Italian index, somewhat surprisingly, after attempting to open up in the green, is now sharply on the back foot, down 1%. This despite the fact that the Italian government introduced a 0.2% GDP package over the weekend to help deal with the effects of coronavirus and lend some tax credits to companies that were seeing a sharp contraction in their revenue. So we have seen stimulus measures being announced out of Italy, one of the biggest measures announced so far out of Eurozone countries, but not reacting so well. And mostly, actually, if you look into the details, Italian banks are the ones trading on the back foot this morning. Perhaps some liquidity concerns there, especially given that a lot of the lending that goes on in Italy is through SMEs and some of the smaller companies that would be exposed. Let's move on and talk about foreign exchange here as well. So you can see a bit of a mixed bag, but we've got the euro trading stronger versus the dollar this morning. So versus euro, the dollar is trading slightly on the back foot, up at 0.5 percentage point, so up through 110.80. Remember, just a couple of weeks ago, the euro was trading as low as about 107. So we have made up some ground with dollar trading on the back foot. But you can see that we are seeing dollar yen actually flight to quality go into the yen, the safe haven currency. 107.80 is where we're at, 0.3 percentage point stronger versus the dollar. And the pound pound also trading on the back foot, down about 0.4 of a percentage point today as well. You can see safe haven also going into Swiss francs. So a bit of a mixed bag versus the US dollar, but mostly what we are seeing is a continuation of money going into foreign exchange safe havens, not so much the theme for equities as we've been discussing, where we have seen a bid overnight. And also, let's just take a quick look at how US futures are going to shape up on today's trading session. You can see that the three majors, S&P, Dow, NASDAQ, are all seen opening up in the green. Dow up north of 300 points, NASDAQ up 100 points. It has been a roller coaster session, even overnight for U.S. futures. There was a very sharp decline for the futures open last night when they started trading. But with the recovery in Asian equities, we're seeing U.S. markets turn around as well. So let's talk more about what happened in the Asian session. Matt joins us with Singapore for a look at exactly what's been going on there. Matt.
Hi there, Jemana. Asian markets broadly in the money despite that woeful news that we got out of China on the manufacturing front for the month of February. And take a look at the China markets, really the outperformer today, up by around about 3% on stimulus hopes that after we got that contraction in PMI that we're going to see authorities there pump more stimulus into the economy. Now, Australia is interesting, lower despite the fact that we might see more stimulus coming out of China, possible RBA rate cut to what's coming through there tomorrow. Let's give you a look at the PMI data. Twin PMIs released in the last few days, but it's the official one that we are watching. Take a look at this number, 35.7, the biggest fall that we've seen on record in February, down from 50 in January and at a record low at that level. The cash in the private sector also falling sharply as well. Guys, back to you.
Matt, thank you so much for bringing us the latest on the Asian markets. Now, just this morning, Hong Kong's retail sales came in, falling 21.4% in January compared to a year ago due to coronavirus. It's the 12th month in a row that sales have tumbled. The epidemic has brought tourism to a standstill and has worsened an already weak environment following months of anti-government protests. Alicia Garcia Herrero, chief economist for Asia Pacific Natixis, joins us now by phone. Alicia, thank you so much for being with us this morning. So some pretty dismal numbers out of Hong Kong on the retail front. This is obviously a continuation of a very weak trend in Hong Kong. When we think about the impact from coronavirus, will the retail sector be hit harder than it was during the SARS outbreak?
Well, indeed, it's already been hit harder, and it will continue to be hit harder. And the reason is very simple. Hong Kong retail sales have expanded 2.5 times since 2003. So this is a much bigger sector for Hong Kong, with 15% of employment, much more than it was the case then. So basically, this is, other than finance, best sector for Hong Kong. And we see the data has not been as horrible as we could have imagined, but simply because coronavirus is a real story since 25th of January. So it's only taken a little bit of that month that we're seeing, but February will be worse indeed.
And we have now seen from the Hong Kong authorities that they are going ahead with essentially this helicopter money, doling out over $15 billion in cash to try to mitigate the impact of coronavirus. How impactful will these measures prove to be, essentially giving Hong Kong residents over around $1,300 in their pocket?
Frankly speaking, I don't think this is the way to make people go to the store, let alone buy online, because they may still be reluctant to go to the store. The very simple reason is that they may just save that money. And that is actually, that would already be a good outcome. Why? Because the worst outcome on earth would be for them to just transfer that money elsewhere, as you can imagine. Hong Kong has a fully open capital account. And if people don't want to spend, they won't spend. If you're lucky, they will keep the money in their account, which won't help the economy. If you are lucky, you see it out as an outflow, which will obviously put pressure on the Hong Kong dollar and on HIBOR. So the best thing in my opinion, you just have to give this money slowly but steadily to make sure that it's being used for consumption, and especially for consumption of what is most affected, which is not everything. So consumption of staples, for example, is quite stable, is going at 0, but not at -20. While, if you look at restaurants or jewelry or, basically consumer durables, especially luxury goods, those are collapsing. So, I think that this helicopter money is simple to carry out as a stimulus package, but not necessarily very effective.
Right. And I also want you to talk me through what you think is going on from a liquidity perspective as well, because clearly that helicopter money is targeted at consumption, but then you hear about these retailers that are losing a lot of cash flows, also similar situation for the property sector as well. Is there talk that there's going to be an actual credit crunch or liquidity crisis of some sort in Hong Kong if this situation continues for the medium term?
Yes, it's a very good question. So indeed, because Hong Kong is runs a currency board, the liquidity in the system depends literally on the amount of inflows versus outflows. I mean, there's not much the HKMA can do. Of course, there is some mechanisms such as T-bills, and basically putting paper back and forth. But first, it's not used very regularly, and let alone selling forex reserves. But that's something that we're very far from now. At the current juncture, you want to avoid a high HIBOR, a high cost of funding for companies. The liquidity needs to be in the system. So any measure that encourages outflows is not a good measure. That's why I go back to the point that you need to target the stimulus for people to spend and not to bring the money outside of Hong Kong. And you're absolutely right that this might be one of the measures where, you could target it better and make sure that the HIBOR remains low so that, the cost of funding for companies, especially SMEs in Hong Kong, remains moderate. Very, very important.
Yeah, absolutely. Thank you very much for your thoughts today. Alicia Garcia Herrera, the Chief Economist for Asia Pacific from Natixis. And so we've been talking about the weakness in Hong Kong retail sales, but it also has been a very heavy trading week for markets, and a lot of the money went into safe havens. So let's take a look at our safe haven board. This morning, we're actually seeing a rebound in gold today, up 1.5%. Surprisingly, gold came off in the session on Friday, despite some of the weakness that we saw in equities. Dollar yen, we mentioned it earlier. We are seeing some inflows into yen and the Swiss franc. And then the 10-year notes in the U.S. also rallying this morning and briefly touched through 1.04%. That is the lowest level ever in overnight trading before coming off. So a big bid for safe haven here. All right, let's bring in Ali Miramati, the investment director from GAM. Great to have you with us.
Good morning.
Do you think that this is an environment where you're better off as an investor just sticking to the safe havens, whether it's currencies or fixed income or even gold, dare I say, though Friday was a bit of a case in point to the opposite, but just stay out of stock markets for the time being until we get further clarification on how things are going with the virus?
I think it's important to remember what happened last year and the context in which markets came into this kind of unexpected event. I mean, last year was a fantastic year for stock prices, not such a great year for corporate earnings. I mean, multiples expanded in Europe and Asia as well as in the US. As a natural function of people following markets, it meant that there was a lot of speculative long position and fully invested people in January, which I think is why equities proved so vulnerable last week to this news. Safe havens, though, I mean, gold, of course, has also had a good year last year, and the most important safe haven or perceived safe haven is obviously government bonds and specifically US government bonds. So I would say that now I think the 10-year yield is something like 1.1% or something like that.
Just below.
So there is already no real return on major government bond markets, given that that's a considerably lower number than current US inflation. So I would suggest that looking over the next 3 to 5 years, which is the time horizon we look at, that probably will not be a sensible place to park one's money. But as for right now, I mean, as ever, pricing the difference that this massive slowdown in economic activity we're seeing now because of the virus, pricing how much of a difference that will make to long-term cash flows of corporates is a tough job. So it's not surprising that people are choosing to put some of their money in cash in the meantime.
So you sit on the sidelines and then wait to get re-involved again at a better buying opportunity. It's all about the timing here, though, because some people talk about the potential for a V-shaped recovery if things get under control. Others talk about U-shape, and now it looks like we may be in an L-shaped type situation where things don't pick up to the extent that they were going to pick up before because of some long-term effects, supply and demand.
Well, I think staying on the sidelines is difficult. I mean, for many of us, I run global and US long-only equity portfolios. We have to always be, to some reasonable degree, invested. And I think there's trying to time events like this is in my opinion and experience not enormously worthwhile activity. I mean, what we do is try to look at valuations and how much they've changed, and where we get the chance to buy good companies at materially better prices. We do it. But I think that's because we have the privilege and opportunity of looking longer term. I think overpaying for safety can be a very dangerous strategy over time.
All right, Ali, we'll leave it there and we'll pick up the conversation in our next segment. Ali Mirmati, the investment director from GAM.
We've got some fresh news out of Russia, out of the Kremlin specifically. Turkey very much in focus over the weekend after Turkey struck a couple of Syrian planes and airports. And now we've got the Kremlin speaking out, saying Russian military has told Turkey it cannot guarantee the safety of Turkish planes over Syria's Idlib region. The Kremlin says Russia hopes Russian journalists working in Turkey will not face problems from authorities there. The stance on Syria from Russia remains unchanged. It wants a Turkish-Russian agreement to uphold. And Kremlin says Putin and Russian oil companies have exchanged views ahead of the OPEC Plus meeting in Vienna, so touching on oil markets as well. So those are fresh comments coming out of the Kremlin after this weekend's developments around Syria. All right, pushing back to corporate news this morning in focus, Rajiv Suri will step down as president and CEO of Nokia in September after more than a decade at the helm of the Finnish telecoms maker. Suri will be replaced by Pekka Lundmark, the current CEO of energy group Fortum. Speaking in the last half hour, Nokia's chairwoman said there are no plans to assess strategic options. Nokia fourth quarter earnings beat expectations, but the company has warned profit will come under pressure as 5G costs ramp up.
And also coming up on Street Signs, a former Fed governor says the U.S. central bank is, quote, bringing a knife to a gunfight as it scrambles to contain the coronavirus impact on markets. We'll discuss in just a few moments.
What I love most about being a scientist at 3M is that I'm part of a community of problem solvers. We make ideas grow from an everyday solution to one that can take on a bigger challenge. We are solving problems that improve lives.
I use Poshmark to sell all the clothes that I haven't worn in months. I can just hop on the app, take a few pictures, put it up, and start selling in minutes. It feels amazing to have a ton less clutter in my closet and make a little extra money on the side.
Download the free Poshmark app now.
The world's newest ocean cruise line is yet again a world's best. Viking's elegant ships deliver a superb, inclusive experience with enriching shore excursions, alternative dining, all veranda staterooms, Wi-Fi, and much more. We're very proud to have been named a world's best 4 years in a row by Travel + Leisure readers. Learn more at vikingcruises.com.
A live bookkeeper is helping customize QuickBooks for me.
Okay, you're all set up.
Thanks. That was my business key. This one's casual.
Get set up right with a live bookkeeper with Intuit QuickBooks.
Do you have concerns about mild memory loss related to aging? Prevagen is the #1 pharmacist-recommended memory support brand. You can find it in the vitamin aisle in stores everywhere. Prevagen, healthier brain, better life.
Do you worry about going to the dentist? Well, relax. The Carefree Dental Card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-478-0809 to receive your free Carefree Dental Card information kit.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school. Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
CNBC
CNBC events at work. Overwhelming responses to this exclusive in-person experience. Lead or be left out. CNBC at work. Register now at cnbcevents.com.
Welcome back to the program. Let's talk U.S. politics. Former Vice President Joe Biden was the big winner in Saturday's South Carolina primary. He easily outpaced Vermont Senator Bernie Sanders and has gained momentum heading into Super Tuesday, when voters in 14 states will go to the polls. That will likely shape the next phase of the presidential race. So very important of a day for voters. Pete Buttigieg has dropped out of the Democratic presidential race. The former Indiana mayor made the announcement last night, despite having early success in Iowa and New Hampshire. He had a poor showing in the South Carolina primary.
Meanwhile, the U.S. has announced new measures in response to the coronavirus as the country recorded its second death over the weekend. Washington has extended its travel ban on Iran to include the restrictions on anyone who has recently visited the country. Travel advisories have also been issued on affected areas in South Korea and Italy. President Trump also said he will be meeting with pharmaceutical companies later today to discuss a possible vaccine. And over the weekend, President Trump also attempted to calm nerves over the virus spread stateside.
We've taken the most aggressive actions to confront the coronavirus. They are the most aggressive taken by any country. And we're the number one travel destination anywhere in the world, yet we have far fewer cases of the disease than even countries with much less travel or a much smaller population.
Tracy, we just heard the president there saying that the U.S. has taken some very aggressive measures to help combat the spread of coronavirus. What exactly measures have the U.S. taken at this point, and what more can we expect to see out of the administration in coming weeks?
Sure, Germana. So first, we were already screening people before they got on a plane headed to the United States from high-risk areas. Now the president wants to add another screening once they land here in the United States, given the fact that we have seen some people get sick on the plane. Obviously, that's a closed environment where that virus could possibly spread. So re-screening here in the United States. The CDC, our Centers for Disease Control, now on the ground, trying to figure out how some people contracted the disease. Some are clearly travel related. Some are community contact related with people who traveled, but others they simply don't know. And so they're trying to now figure that out. There have been 150,000 test kits ordered for this virus. Half of them are ready, half in a couple of weeks. So they expect to be testing a lot more people than the 3,600 that they've tested so far. And also, we've now had our second death in the United States, a nursing home patient in Washington State, and we're seeing new cases crop up on the East Coast in New York, in Rhode Island. All of those, or both of those new cases, I should say, in those states are travel related. But again, they're trying to pinpoint that and also prevent unnecessary fears. The federal government saying that the risk for the average American is low, but we're already seeing a run on masks in some places, people using face masks, and that's a concern that healthcare professionals may not be able to find them when they need them.
No, most definitely, and it's an issue worldwide, Tracy, not just in the U.S. Thank you very much for that report from Washington. Quick look at U.S. futures. This coming on the heels of a very heavy week of trading last week, with the majors down about 12% in aggregate for the week. But today, things are looking better. S&P down, NASDAQ all seen opening up in the green. A quick look also at commodities this morning. We're seeing a bounce in WTI up 2%, and this after touching lows not seen since December 2018 for the crude complex. Worth bearing in mind that we also have the OPEC meeting coming up this week as well. So a lot of anticipation ahead of that meeting and what OPEC Plus could do to curb production further.
Let's get back to Ali Miramadi, investment director from GAM, who joins us around the desk. Looking at sector performance today, the financials are coming under a great deal of pressure. The Italian banks in particular down 5-6% in some cases, but more broadly, banks are also underperforming. What do you pin that weakness down to? Is it expectations of more easing from central banks? In Italy's case in particular, how much of that has to do with concerns around credit risk in the country?
I think the move in the banks, I think, is explained by the fact that Europe will now almost certainly shrink, or its economy will almost certainly shrink in the first half of the year, and so accounting rules mean that provisions will have to go up, which has a direct read through to net income. I mean, we know from UniCredit, for example, which has actually been given permission by the ECB to buy back shares. Capital return, is an important part of the ongoing story for the better run banks, which I think, by the way, would very much include UniCredit. But their ability to return capital clearly will be materially diminished if they're having to take greater provisions, on the basis that the economy is not doing well. So I think the banks are, as has been the pattern for most of the last decade, just find themselves, in an unfortunate position.
And what about asset managers here? Obviously under a great deal of pressure when we look at the equity performance, but also the credit risk here. How vulnerable are asset managers in Europe?
Well, that's interesting. I'm not sure that, other than the fact that, of course, that equity portfolios are, broadly speaking, going to be worth 10% less than they were, which hasn't to read through to AUM. I'm not sure asset managers are an obvious place to look for risk. I mean, the big theme in that industry clearly is consolidation. But I don't think that relates to, that's a secular trend rather than anything relating to current market events.
Any hedges you're looking at this point?
No, I think, for us, in as much as anything has changed from our perspective, I think economic cyclicality, remains difficult. Long duration businesses will quite possibly be revalued higher, given the even lower prevailing level of long-term interest rates. So I think, we're long-only investors. We don't do hedging, but I think that coming out of this, the higher quality businesses may find themselves with an even greater premium than was the case previously.
Right. Buying opportunity then. Ali, thank you very much. Ali Miramati, Investment Director from GAM. And that is it for our show today. Worldwide Exchange is coming up next.
Power outages can be unpredictable, inconvenient, and disruptive to your life, posing a real threat to your comfort and safety. When the power goes out, you have no lights, no refrigeration, no heating or air conditioning. Your well or sump pump won't work. Your modern daily electronics are rendered useless. And what if the power's out for days or weeks? Are you prepared? You can be with a Generac home standby generator. 24 days we were without power. I had water, I had ice, I had coffee, I had air conditioner. I was able to stay here because of Generac. When an outage occurs, your Generac home standby generator automatically powers up, so your life goes on without disruption. You and your family are comfortable, safe, and secure. Generac generators run on your home's existing natural gas or propane. And Generac's standard Mobile Link remote monitoring system keeps you posted on operating status, maintenance updates, and more. Generac generators are designed, engineered, and purpose-built in the USA. Generac is the #1 manufacturer of home standby generators in the world. 8 out of 10 home generators are Generac, with thousands of satisfied customers.
Very good product. Very, very good reviews from everybody.
Prices start at just $19.99, and special financing is available with surprisingly affordable monthly payments. Call now to schedule your free in-home assessment with one of Generac's 6,000 nationwide dealers. The call is free, the assessment is free, and there's no obligation to buy. Plus, if you act now, you'll receive a 7-year extended warranty absolutely free. That's a $695 value. Call now, so the next time there's a power outage, your home powers up. Power your life with Generac. Call or go online to schedule your free in-home assessment today.
It's time for a special announcement from Four Seasons Sunrooms and Windows. Transform your home and change your life with a Four Seasons sunroom. And watch this announcement until the very end for a special code for exclusive additional savings. And now it's time for Four Seasons. It's time for family gatherings, to stretch imaginations, to get together or find some time alone. It's time for a Four Seasons sunroom. And right now, Four Seasons has special offers that let you have it all for less money than you thought. With no money down and no interest for 12 full months. Call Four Seasons and get your free quote and information today. Thanks for watching. Now call the number on your screen and mention the special code TIME and receive exclusive additional savings on your new sunroom. Four Seasons. It's time.
Read. Read yourself past the junk, past the hashtags and the troll armies, the partisan pandering, past all the social media that's making your head feel like, past the gossip mags and millions of stories uploaded each day. Read yourself past the algorithms, because no one ever did anything big by reading small. Read yourself better.
It is 5 a.m. at CNBC Global Headquarters, and here is your 5 at 5 Markets and Turmoil edition. Stocks are in rally mode after closing out their worst week since the great financial crisis. Dow futures swinging more than 900 points to the upside on hopes central bankers around the world will step in at some point. This as Goldman Sachs is out with another bombshell note saying Jay Powell will act sooner rather than later. Plus, two more airlines making changes as virus hits really demand there. And Omega's Leon Cooperman taking on President Trump over his treatment of the Federal Reserve in times of crisis. It is Monday, March 2nd, 2020, and Worldwide Exchange begins right now. Good morning and welcome to the show. I'm Dominic Chu, in today for Brian Sullivan. With me for the entire hour, Bleakley Advisory Group Chief Investment Officer and CNBC contributor Peter Bookfar will be with him in just a moment here, kicking off this Monday morning with a global rebound as markets around the world bounce off their worst week since the financial crisis. Right now, stock futures indicate what could be a nice open to the upside, about 175 points. However, just within the last hour, we were up as much as 400 to 500 points implied, so we'll see if that moves. Now, the Dow Jones futures, you can see here, have been going from losses all the way to gains up here. At one point, we had a range of nearly 1,000 to 1,100 points from bottom to top, so watch those Dow Jones futures. It's been a volatile session so far, perhaps foreshadowing a regular trading session with that same roller coaster dynamic. Now, the bond market's also showing some signs of downside pressure. 109, the last trade for 10-year benchmark government note yields. At one point today, we got down towards that 103 area, setting a new record low for 10-year note yields. 2-year Treasury note yields, 0.765% right now as well. Checking out the action in crude oil prices after hitting its lowest level since December of 2018. The session low for American-based crude is $43.32. You can see right now $45.53 the last trade there, up about 1.75%. We have seen a bit of a downside move in just the last maybe hour or two. Now, let's watch what's happening. A rebound is underway in Asia and Europe as well, as investors hope for action from global central banks around the coronavirus. Matt Taylor is in Singapore. Juliana Tattlebaum is in London. And Matt, we are going to start with you first. We did see some nice green finally in those Asian markets.
Absolutely, Dom. Asian markets mostly in the money today, despite that woeful news that we got out of China on the manufacturing front at the weekend for the month of February. China markets, in fact, the strongest today, up by around about 3% on stimulus hopes after that big contraction in official PMI. Australia, though, this was interesting. Despite potential stimulus coming out of China, the Australian market, of course, a proxy for China, was lower ahead of a possible rate cut out of the central bank there tomorrow. Let's tell you about that PMI data because we did see a big decline right down here. This is the official number, 35.7, down from a reading of 50 in January. We also have the private sector survey falling as well to a reading of 40.3 from 51.1 in the prior month. Dom, back to you.
All right, thank you very much, Matt Taylor in Singapore. To the rally in Europe right now, Juliana Tattlebaum is in London with the latest there. And Juliana, that green theme continues in European sessions.
Well, Dom, that's right. We did see a strong rebound at the open here in Europe with the Stock 600 up more than 2% at one stage. But the optimism has faded in the last hour or so, much like the developments that you pointed out in U.S. futures. Now the Italian index in particular has come under a great deal of pressure, down 1.9%. Italy remains the hub of the virus here in Europe. 90% of the cases remain concentrated in the northern parts of the country. Over the weekend, Italian authorities, along launched a 3.6 billion euro package of easing to try to mitigate the impact of the virus on the economy. But investors still concerned this morning around Italian markets. The German index has also now slipped into negative territory, down about 0.25%. So some of that initial optimism certainly has faded in the last moments of trade. Let's take a quick look at sectors. The banks coming under particular pressure this morning. Banks down about 1.9% here, and the Italian banks, worth noting, are dragging this index down. So very concentrated risk in markets in Europe this morning. On the flip side, healthcare up about 1.5%, food and beverages and oil and gas up 1.3%. So this rally in oil and gas stocks comes alongside the bounce back in crude prices, which you pointed out earlier, Dom. So all in all, a mixed session now for European markets after that strong rally at the open. Dom?
All right, Juliana Teitelbaum live in London with the latest on the European bourses and the action there, to the latest on the coronavirus outbreak now. The global death toll now exceeds 3,000, with a second death reported in the United States. And New York has now its first confirmed case. Rahel Solomon joins us with the latest headlines here. Rahel.
Hi, Dom. So New York Governor Andrew Cuomo has confirmed his state's first case, but didn't offer many specifics. We do know that the patient is a woman who recently traveled to Iran and is reportedly now isolated in her Manhattan home. This is as companies continue to take action as the outbreak spreads. Nike now saying that it's temporarily closing its European headquarters in the Netherlands after an employee was infected with the virus. American Airlines is waiving change fees on all newly purchased tickets. And United Airlines CEO Oscar Munoz telling employees that his company will likely need to cut additional flights. Both these moves come, Dom, as the travel industry, of course, deals with declining demand.
All right, Rahel Solomon, thank you very much for those updates on the coronavirus. Back to the markets now. Stock futures indicating what should be a green open right now, but it's well off the session highs. We were just about 150 points to the upside implied right now. About an hour ago, we were 400 to 500 points implied positively. Goldman Sachs over the weekend out with a new note predicting the Fed will cut interest rates by 50 basis points, half of 1%, at or before its next meeting later on this month. An additional 50 basis points, 0.5% worth of interest rate cuts in the second quarter as well. Goldman also says to expect action from policymakers, not just here in the U.S., but also Canada, the United Kingdom, Australia, India, and more. With me now for this hour is Peter Bookvar. And Peter, I got to say, the central bank theme has been a driving force behind supporting markets for the better part of, say, a decade now. Why is it that the coronavirus fears really did not respond to the idea that the central banks could actually step in and help?
Because they realize a rate cut or two is not a vaccine, and it's not going to address supply issues out of China. It's not going to make people get back onto a plane or get back into a casino. It's just not the antidote to what ails us right now. What the antidote is actually seeing a plateauing of this spread. That's the answer to this, not some wasted rate cuts, which I know that they'll do, but it's not going to really help economic growth. Now, maybe it'll grease the wheels of the financial markets for a short period of time, but I'm more afraid that they do this, the markets rally for a short period of time, and then just give it all back, and then these cuts are then wasted.
So it's interesting to put this move in perspective with what's happened over the course of this past, say, year and a half, with regard to drawn-out trade conflict between the world's two largest economies that seemed to get resolved at the end of last year. The trade war had nothing like this in terms of impact. So the economic growth scenario is still there, but this is a bigger threat than the trade war, apparently.
No question. The world was not prepared in terms of the pace of economic growth and the valuations of asset prices going into this. Global growth was only about 3%. U.S. growth was only about 2%. You had credit spreads at the tightest level since 2007. You had valuations in the equity markets at 20 times earnings. We were not set up for something out of left field that is going to rock economic activity. So whereas SARS, it was after the NASDAQ had fallen 80%. H1N1, it was after the financial crisis when we actually had more important things to worry about. So it was sort of the positioning for this that is making it more profound.
What we want to show, Peter, right now, viewers and listeners on Sirius XM channel 112, we're showing a graphic that says falling below key levels. The 200-day moving average is a longer-term trend line that a lot of traders like to watch for an indicator of momentum longer term. The S&P 500, bank ETFs, Dow transports, energy, industrials, materials, financials, discretionary, basically every sector out there, along with the broader market, is now falling below a key longer-term trend line. Does that mean that this is the buy the dip opportunity people have been waiting for?
Well, that's the mentality that people have been trained on for the past decade, because central bankers would be the stimulant for that kind of behavior. But I think people have to be more careful this time around, because they have to understand that central banks right now are going to be shooting blanks. They're going to give us what they think they can give us, but there's going to be blanks in that gun. I'm just warning people. Again, the answer to what ails us is an end to the spread of this virus, not central bank rate cuts.
So liquidity won't save us from a virus outbreak?
Correct.
All right. Peter Bookvar, more with them to come. Don't go anywhere. When we come back on the show, trouble at Twitter as activist investors troll its founder and CEO. Those details coming up next. And as we head out to break, all 30 Dow stocks components are in correction. That's so-called correction, down 10% or more, barring this morning's rally, with an 11 of them in bear market territory, down more than 20% from their recent 52-week highs. Names like Boeing, Exxon, 3M, Disney, all part of that story. A very busy hour still ahead when Worldwide Exchange returns after this commercial break.
I'm 52, but in my mind, I'm still 25. That's why I take Osteo-Biflex to keep me moving the way I was made to. It nourishes and strengthens my joints for the long term.
Osteo-Biflex, now in triple strength plus magnesium.
Every morning, 17,000 Edward Jones financial advisors come to work with one goal in mind: to treat their individual investors like individuals.
Let's get started.
Edward Jones, it's time for investing to feel individual.
Do you have concerns about mild memory loss related to aging? Prevagen is the #1 pharmacist-recommended memory support brand. You can find it in the vitamin aisle in stores everywhere. Prevagen, healthier brain, better life.
Will the bears continue their run, or will there be signs for turnaround in the turmoil? The read on early trading signals for investors. Squawk on the Street, 9 a.m. Eastern today. Watch or listen live on the CNBC app.
Wondering which credit card is right for you? Introducing CNBC Select, the authority on all things credit cards. We do the research, you reap the rewards. Head on over to cnbc.com/select and take control of your money.
Do you worry about going to the dentist? Well, relax. The Carefree Dental Card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-478-0809 to receive your free Carefree Dental Card information kit.
Life Room by Four Seasons, where outdoor living meets future technology. No matter your style or budget, Four Seasons has got you covered. Simple shade from the sun? Covered. Outdoor dining in style? Covered. Need additional living space? Oh yeah, that too. Call today and arrange your free design consultation. Four Seasons, we've got you covered.
Welcome back to the show. Let's take a look at some of the Dow pre-market gainers right now. That includes Apple, Home Depot, and Boeing. Each of those shares up just around 2% pre-market if these gains do hold into regular trading. Well, Twitter may be gearing up for a fight with a major activist investor over control of the CEO office. Rahel Solomon joins us now with that story. Rahel.
Hi, Dom. So sources tell CNBC Elliott Management founder Paul Singer is seeking to replace Twitter CEO Jack Dorsey. Elliott is pushing for Dorsey's removal partly because his focus is split between running both Twitter and Square. He began a second stint as the company's CEO back in 2015. In November, you might remember, Don, that Dorsey also tweeted that he planned to live in Africa for 3 to 6 months this year. Well, that announcement surprised executives and apparently angered some investors frustrated with the company's performance. The Wall Street Journal now reporting that Elliott has taken a roughly $1 billion stake in Twitter and has been in talks with management about perhaps finding a full-time CEO. The firm has also nominated 4 directors to the board. Elliott, of course, is known for proxy fights with companies such as AT&T, but the Journal says, at least for now, it may be working with Twitter instead of waging a public campaign. It nominated the directors before a recent deadline as a backup plan in case talks fall apart. Twitter has failed to deliver steady earnings growth. The stock is also little changed since Dorsey returned to the CEO role. Meantime, Facebook has more than doubled. You can see Twitter is up just about 7% in pre-market this morning.
This is interesting. Look at this. So this is a chart since 2015. What you want to look at right there for folks kind of watching right now and for folks listening in is over the last couple of years, this stock has troughed and actually had some great upside momentum.
It sure looks like it.
Up until September of last year when things really started to kind of just fall off there. So this could be a situation now where Twitter is a company that has to show that it can actually get back to some of those levels and user engagement and growth that it had over the course of the past couple of years.
And Jack Dorsey himself, right, especially when compared against Facebook, and you're seeing that growth there. You don't see it with Twitter. They're feeling like maybe his focus is a little bit little spread.
Yes,
maybe he's spread a little thin these days. And
it's hard enough to be CEO of one company, to be CEO of 2 companies.
Square and Twitter,
yeah,
sure.
I mean, you would have to believe he himself would say, you know what, this is just way too much for me.
Yeah.
I mean, both those companies are not small in any way, shape, or form either.
Exactly, yeah.
And the Africa announcement also sort of unsettled some people. So
well, there's no
there were
doubt.
a lot of questions about what he would be doing.
It's a big year for catalysts between the elections, the Olympics, and everything else. Social media should be a big thing. All right.
There.
Thank you very much for your help. Peter, you're sticking around. Still on deck for the show, a warning from the World Health Organization over coronavirus containment. Our Hadley Gamble is coming up with those exclusive comments made to CNBC by the head of the WHO, plus the 5 worst Dow stocks for the month of February. Worldwide Exchange is back right after this.
Today's big number, $3.9 trillion. That's how much market cap the S&P 500 has lost since its record high of February 19th. The index has tumbled 13% since then.
Hey, I'm Alex.
Ah, the noob. Enter. Come around here. I'll show you how we do things.
Perfect.
Oh, you got your basic productivity suite here. You got your email. You got your company portal, production portal, sales app, and social. My avatar's a Manticore. The HR sites. Put your hours there, PTO there. Payroll's a different beast entirely. Cloud storage, doc storage, which require a 15-digit passcode changed every 9 days.
So how do you get anything done around here?
Oh, for that we use Smartsheet.
Great.
Get right to the work that matters with Smartsheet.
These are our sales, by product, by region. You can actually see taste trends.
Since when can we do that?
Since we started working with BDO.
People who know BDO.
The world's newest ocean cruise line is yet again a world's best. Viking's elegant ships deliver a superb, inclusive experience. With enriching shore excursions, alternative dining, all-veranda staterooms, Wi-Fi, and much more. We're very proud to have been named a world's best 4 years in a row by Travel + Leisure readers. Learn more at vikingcruises.com.
Selling on Poshmark is crazy simple. All you have to do is post a picture, add a description, add a price, and you're pretty much good to go. Right now I'm selling Air Jordans and Nikes and Adidas, anything really performance related or style related.
Download the free Poshmark app now.
You're doing more to keep your body healthy for the future. Shouldn't your toothpaste do the same for your mouth? Future-proof your whole mouth with new Crest Proactive Defense. Its active defense technology neutralizes bacteria to shield against potential issues. Crest.
What if you invested $5 a day, every day, and you invested the spare change from everything you buy? And what if your market returns were reinvested automatically? And imagine if you did this for a while, so your money could grow. And what if all of this was easy?
WW has been an amazing journey. It's almost like a challenge every day to see how well I can eat and still enjoy myself all day long. I wake up every morning to see how much weight I've lost and how much better I look.
My WW. Join for free and get 3 months free.
Welcome back to Worldwide Exchange. Let's get a check of some of the stocks on the move so far today. A major Barclays investor is calling for CEO Jes Staley to step down over his ties to disgraced financier Jeffrey Epstein. Sherburne Investors owns a more than 5% stake in Barclays, and last week Barclays revealed Staley was being investigated by UK regulators over whether he had been transparent about his relationship with Epstein. Barclays shares off about 3% in European trading. Nokia says CEO Rajiv Suri will step down in September after 6 years at the helm. He will be replaced by a former Nokia executive. The company has struggled to regain investors' confidence after a surprise profit warning last October forced it to admit delays in developing its 5G wireless technology. Those shares up 1.5% in European trading. And Harley-Davidson CEO Matthew Levatich stepped down on Friday in a mutual agreement with the board of directors. Harley's revenue has declined over the past 5 quarters as it struggles to appeal to younger riders. Board member Jochen Zeitz has been named the acting CEO. Those shares up 5% in the extended trade. Well, still ahead on the show, where the chief investment officer of Nuveen Investments is putting his money after stocks suffered their worst week since the financial crisis. His firm has more than $1 trillion in assets under management. Plus, here are the top S&P 500 gainers in the pre-market so far today. We're back right after this.
Stay restless with the icon that does the same. The new RX, crafted by Lexus.
Lease the 2020 RX 350 for $419 a month for 36 months.
Experience amazing at your Lexus dealer.
When your skin is feeling dry and crinkly, time for Gold Bond Healing Lotion. Penetrates 10 surface layers deep with 7 moisturizers, 3 vitamins. Skin is nourished, healed, healthy looking. Gold Bond Healing. Ultimate lotion, ultimate skin.
Read. Read yourself past the junk, past the hashtags and the troll armies, the partisan pandering, past all the social media that's making your head feel like, past the gossip mags and millions of stories uploaded each day. Read yourself past the algorithms, because no one ever did anything big by reading small. Read yourself better.
Do you worry about going to the dentist? Well, relax. The Carefree Dental Card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-478-0809 to receive your free Carefree Dental Card information kit.
Life Room by Four Seasons, where outdoor living meets future technology. No matter your style or budget, Four Seasons has got you covered. Simple shade from the sun? Covered. Outdoor dining in style? Covered. Need additional living space? Oh yeah, that too. Call today and arrange your free design consultation. Four Seasons, we've got you covered.
Welcome back to Worldwide Exchange. Would you believe that about a week ago, 10-year government note yields were north of 1.35%? Over the course of the past week, even today, the highs of the day, we were at 1.15. At the lows, 1.03. A huge move in government note yields. We're still tracking it. Keep it right here on Worldwide Exchange. We'll be back right after this break.
Ship Skis presents Ski Moguls.
Welcome to beautiful Telluride. Hi, I'm Brenda Fuglione.
former U.S. ski team racer. The holy grail of advanced skiing is untracked powdered snow. Here are a few tips to maximize your fun in fresh powder. First thing, it is a myth that you want to sit back in the powder. This will make you tire very fast, so keep your weight centered on your skis. Second, it is good to keep your legs together and keep weight on both skis. This will prevent you from catching a single ski in the snow and pulling you down. Third, when you're skiing powder, think of being in slow motion. You want to be graceful and not pressure too hard on your skis. It is beneficial to establish a rhythm, down in the turn and up in between. We look forward to seeing you put these tips to use in the powder at Telluride Ski Resort.
Presented by Shipskis. For more, go to cnbc.com/skimoguls.
Whether you've enjoyed the legendary terrain in Telluride, the unparalleled landscape of Park City, or the famed peaks of Whistler, you face the hassle of lugging your gear through the airport. With Shipskis, you're just a few clicks away from having your skis, snowboard, and luggage shipped from your doorstep to your destination. With unrivaled pricing, real-time tracking, Shipskis delivers hassle-free. Ship ahead and go catch those first tracks on fresh snow. Shipskis, your skis delivered.
We can't calculate our total taxes?
Sales tax, real estate credits, solar incentives.
And we have no way to integrate all that.
No, but BDO does.
People who know BDO.
Your skin has different needs at night. That's why there's Gold Bond Overnight Lotion. Works while you sleep, penetrating 10 layers deep as hyaluronic acid locks in moisture. Wake up to rejuvenated looking skin. Gold Bond Overnight Lotion.
I was going to shut down my family bookstore, but the Indian rhinoceros saved it. In my travels through Kaziranga, I heard the story of the rhino.
50 years ago, there were only 400 rhinos. But now, there are more than 2,400.
India showed me what can happen if you don't give up. And if the Indian rhino can make a comeback, so can my bookstore.
Hold on to your hats. We look set for another wild ride on Wall Street. Stock futures are up right now, but they've traveled more than 1,000 points in a very volatile overnight session for futures on the Dow. The U.S. on high alert as officials report a second death in connection to the coronavirus outbreak in the U.S. and central banks to the rescue. What Goldman Sachs is telling clients to expect from Fed Chair Jay Powell. It is Monday, March 2nd, 2020, and the second half of Worldwide Exchange begins right now. Welcome back to the show. I'm Dominic Chu in for Brian Sullivan today. Still with me for the hour. Bleakley Advisory Group Chief Investment Officer, also CNBC contributor Peter Bookfar. Stay right there. We're going to get right to you. Kicking off this second half hour with a global rebound as markets around the world bounce off their worst week since the great financial crisis. Right now in the United States, stock futures point to a positive open, but not by as positive as they were just an hour ago. The Dow would open up by about 165 points, the S&P by about 13, and you can see here the Dow Jones futures, we have traveled from the lows to the highs over 1,000 points at one point. Again, we've lost some momentum over the course of the past hour and a half or so, but still, watch those Dow Jones futures. If they are any indication of the ride we'll see, the regular session could be pretty bad. Now, the wild ride they had, we have indicated losses of about 430 points at one point last night. Right now, you can see there are some moves to the higher. Now, in the bond markets, we have seen a move lower in 10-year note yields, 1.07%. That's actually higher than the 1.03% that we got earlier overnight. That, by the way, a record low for 10-year note yields. The 30-year long bond for the United States, 1.64%, and the 2-year note yields firmly below 1%, just a hair below 73 basis points or 0.73%. Checking out the action in crude after hitting its lowest level since December of 2018, the session low for U.S. benchmark crude WTI, $43.32 right now, 1.5% to the upside, $45.45 there. We have global team coverage for you this morning as we track the market action and headlines surrounding the coronavirus outbreak. Matt Taylor is in Singapore with the Asian action. Juliana Tattlebaum live in London with the European bourses. Eunice Yoon standing by in Beijing with the latest on the ground there. And Hadley Gamble is in Dubai. Matt, to you first, and new comments from the Bank of Japan just overnight.
That's exactly right, saying that they stand ready to help out the markets if we continue to see this volatility. Japanese markets, along with South Korea, moving higher, but China was really the standout performer today, up by around about 3%, despite that woeful manufacturing data that we got out. This has really prompted stimulus hopes coming out of authorities in China, that record contraction when it came to PMI. Let's remind you of the numbers. China, of course, the best performer around the region today, because we did see the PMI falling to a record low of about 35 over the month of February. Of course, this is down from a number of 50. You can see it here, 35.7, down from 50 in the previous month. The Kaishan, the private sector survey, also plunging as well, down to 40.3. Dom, back to you.
Matthew Taylor live in Singapore with the latest there to the early trade in London now. Juliana Tattlebaum joins us now. Juliana, those European bourses, are they holding up?
Well, Dom, it's been a rocky session and markets have only been open for a couple of hours after a very strong rally at the start. That optimism faded in the next hour or so of trade. Now, just in the last moments, we have bounced off the lows of the morning. The German index, the DAX, is currently teetering around the flat line. But the real pressure this morning very clearly coming out of Italy. The FTSE MIB down more than 2%. Italy home to the largest outbreak in Europe of coronavirus. Over the weekend, we heard from Italian authorities that they are launching a 3.6 billion euro stimulus package to try to offset some of the negative impact of the virus. But investors are concerned around the Italian banking sector. So let me just show you how banks are performing this morning in the context of a broader sectors. Banks down 1.8%, and the bulk of that selling is coming in the Italian banking space. But we are seeing some green on the board as well. Food and beverage up about 1.6%, healthcare up 1.6% as well, and oil and gas, the majors in the equity market, are performing well this morning. That sector up 1.3%, right alongside the bounce back in oil prices seen in the latest trading session. So putting it all together, a fairly mixed session at the moment for Europe, but a volatile one. So continue to watch what happens here in the lead up to the Wall Street Open. Dom?
All right, a little bit of slowing momentum for those European markets. Thank you very much, Juliana Tattlebaum, live in London. Now to the latest on the coronavirus as the U.S. reports its second death and first confirmed infection in New York City. Our Hadley Gamble joins us now live from Dubai, where she sat down with the Director General of the World Health Organization, offering his own outlook for the outbreak. Hadley, what did he have to say?
Dom, there was a wide-ranging conversation, and essentially what I was able to draw from the Director General of the World Health Organization is that they still don't know what they don't know. He was essentially saying to me that when it comes to containing the coronavirus, the window to do that is narrowing. Listen in.
And no panic, no fear. We need to focus. Of course, concerns and worries are there. There should be. But we should be calm down and work. And stigma also should be avoided, which we are seeing and which is dangerous. This virus is everybody's enemy. Everybody's enemy. And as human beings, we should stand in unison. Discriminating and stigma is the worst. It's more dangerous than the virus itself.
So the World Health Organization essentially saying there, we've got to avoid panic, we've got to avoid fear, because at the end of the day, we still don't know what we don't know. We don't understand how quickly this is really going to continue spreading. We know that they've slowed down in terms of reporting of cases in China. We know that Iran is still a major area of concern, Italy a major area of concern, and the rest of Europe. Obviously, we're talking about the United States. I asked him, is the U.S. response good enough? He says each country has to decide for itself what it needs to do exactly to combat this virus. Listening to what he had to say about the markets, though, specifically, I asked him if they were in need of a serious reality check.
Yes, global markets, it's to everybody, by the way. They should calm down and try to see the reality, as you said, reality check. Facts, figures, and, decide based on that. Rational. We need to continue to be rational. Irrationality doesn't help. We need to go back into the facts and the figures, and based on that we decide.
So the director general there essentially talking about Iran, he talked about China, he talked about Italy and Europe as well, he talked about the United States, but the one thing he wasn't really able to clarify, and which I pressed him on again and again, what was the threshold that he is looking for at the point which they have to declare this a pandemic? He really wasn't able to give me those hard numbers, those data, those facts. And part of that is because they're still collecting all of that data. The WHO is sending a team to Iran today, but also they want to take longer, they want to take some more time. And you remember my interview with the U.S. Treasury Secretary just a couple of weeks ago on the sidelines of that G20 conference, Tom, he was essentially saying to me the same thing. It's going to take 3 to 4 weeks to understand the shakeout in terms of what this means for not just the U.S. economy, but the global economy as well. And that was echoing, frankly, comments that we'd heard from the Director General of the WHO, but that they still don't have enough data yet to see exactly what this is going to mean for the world. Dom?
Hadley, can you tell us, you're in the region right now, what are your sources on the ground saying about the moves that we've seen in oil prices? There's some chatter about possibly OPEC and its partners looking to maybe move on production cuts. It's helping to bolster the markets today. Is it a reality? Can we expect to see some kind of action from OPEC in the coming days and weeks?
No doubt about it, Dom. We're definitely going to be witnessing a live, as you would say, OPEC meeting, OPEC plus meeting in the coming days. And we'll be there, of course, bringing that to you from Vienna. And one of the things that we've heard again and again from sources on the ground, not just here in UAE, but in Saudi Arabia as well, is that this is seen in many ways as a vindication of His Royal Highness, the Saudi oil minister. A few weeks ago, you remember that technical meeting. He was pushing the Russians. He was pushing members of OPEC to come to the table for more cuts. That was just as coronavirus was starting to become a big thing and a worry for the markets. And it seems as if he's been vindicated, at least so far, with what we've seen in the price, and certainly folks here on the ground telling us, behind the scenes at least, that they're looking to move on further cuts. Dom?
All right, Hadley Gamble live in Dubai with the latest there on the coronavirus and the oil markets. Thank you very much. Dow futures trading well off their session lows, but again off their session highs as well, right in the middle. This has stocks come off their worst weekly point decline in history, sending all of the Dow 30 into correction and 11 into so-called bear market territory. Names like Boeing, Disney, Cisco, 3M, all down more than 20% from their recent 52-week highs. Back with me now is Peter Bookvar, and joining the conversation now, Brian Nick, Chief Investment Strategist at Nuveen, with more than $1 trillion in assets under management. Gentlemen, thank you both very much. Brian, we'll start with you this time around. We've seen the markets, and there's been an argument made that markets were, quote-unquote, overbought. They were too far to the upside. They're overvalued, overextended, everything else. They're definitely not there now. Is this the bottom that we've been looking for?
I think it's too early for us at Nuveen, at least, to call the bottom. I think the other thing we have to think about is, yes, we were seeing very high valuations coming into this period, the highest in 20 years by some measures. One thing we're doubting now, even though they come back down, is the PE ratios are back down to average, but what is the E? Does that need to come down further? Are we going to see earnings revisions to the downside? We've only started to see that. So are we actually sitting at more expensive levels than we think? Yes, stocks look a lot cheaper against cash and against bonds, but against their own history, I think we have to wait to see how this shakes out.
So what's interesting to me is over the course of the past few days, we've had a number of large investment banks and their analyst economist teams come out and say, we could see no earnings growth for the year 2020 because of the coronavirus. So to the E point that you were just saying, does that make you feel as though this is still a situation where the markets can extend lower?
I think so. I think coming into the year, we thought the earnings expectations were too high when they were 10 or 11%. We were more in that 0 to 5% category. So we probably need to see them come down substantially more. We didn't enter the year as bulls on the U.S. stock market. We were thinking kind of flattish. I think at this point, flat looks like a pretty good return for the year from where we're sitting right now. But, you know, it's much more for us about where do we see the opportunities? How can we, outperform the benchmark if the benchmark's not going to be doing much, at least for the foreseeable future?
Since you just opened the door, where exactly are the opportunities that you are seeing? What has gone on your shopping list as the markets have fallen in some ways by 10, 15 or more % for certain stocks?
I think anything with a high yield is going to catch a bid for as long as there's uncertainty about when the plateauing seems to arrive when it comes to the spread, both by country and by the number of cases we're seeing of the coronavirus. So for the time being, we're defensive. We're trying to orient that more towards growth, towards areas that could be part of the eventual bounce. So we're kind of trying to play the middle, not trying to hit a home run by being, catching a falling knife in a very cyclical sector, but also not getting too defensively oriented. So we're looking at sectors like healthcare, sectors like technology, the same sort of playbook that got us out of the last one of these kind of swoons that we saw at the end of last year with the trade war and the resolution.
So it's interesting. Brian brings up an interesting point here, Peter, with regard to the E side of things, earnings. A large part of that component will be the macroeconomic backdrop that these companies have to operate in. And there's no doubt there's going to be a global slowdown. How intense will that slowdown be, and will it really have a real material effect on earnings?
Well, going into this, global growth was only around 3%. U.S. growth was only about 2%. So there wasn't much of a cushion to deal with what we're dealing with right now. So I think it's obvious that many countries, for sure, will see negative prints in Q1, and the U.S. will probably see a GDP number, possibly with a one handle, and maybe even below, and that carrying over into the second. I think the big question is what kind of recovery do we see in the second half, assuming that we get this somewhat in control in the next couple of months. Now, that obviously remains to be seen. The economic impact for sure is more intense than what the health impact is of this, but you still can't discount human nature. People just get scared. They get in this hysteria. You go into Costco over the weekend and the shelves are empty for toilet paper.
I passed Costco just anecdotally. I drove by my local one this past weekend. The line of cars waiting to get in was around a block where I was. So there is certainly a mentality developing here. Now, Brian, I guess to your point, are you forecasting or are you expecting to see some kind of a real slowdown in the consumer? It's been one of the pillars of the global economy, the U.S. consumer specifically. Is this going to dampen consumer sentiment?
This has been the one thing that's held us up with all these prior corrections over the last 10 years or so, has been the U.S. consumer never really went away. We've seen dips in consumer confidence, but we really haven't seen consumer spending slow down. A couple of positives. Consumer spending coming into this period still looked pretty solid. So I think the first quarter numbers incorporating a strong January that was really unaffected by this in the U.S. We're still seeing strong consumer confidence numbers for February and a very high savings rate. I think we can't discount that either. Now, savings rate's okay if you can't get to the store to get something to buy. The savings rate doesn't help you that much, but we think that consumers and households are pretty well prepared for at least a softer patch in the U.S. economy. The question is, does this extend into Q3? We know Q1 is going to be kind of sliding down towards February and the end of March. Q2 could be potentially the weakest period for the U.S. and the global economy. But do we see a V-shaped recovery or do we see an L-shaped recovery, which means we really are in a demand shock, which makes this different than
I've seen the V, U, or L scenarios play out for everybody right now. So what exactly is then your playbook? How do you strategize an actual plan for how to tackle the next 3 quarters?
First, stay humble, because this is different in that this is a virus. This is not going to dictate consumer behavior the same way that, say, the trade war could, where we get good news, there's going to be a deal. That never really affected consumer spending in the first place. But this is something that, regardless of how low the Fed cuts interest rates or what company earnings look like, this could be a question of, do people just not want to take flights, take vacations? So there could be a sincere demand shock here. The nature of the recovery, I think, is going to depend very much on what happens with the news flow with the virus. So we're optimistic about Q3. It does feel like the equity markets, at least, are looking past this to more of a V-shaped recovery, similar to what we got last year. I think the other markets, fixed income, for sure, are not forecasting a bounce in interest rates anytime soon.
Peter, where are you allocating to? I mean, you have a client list and you have a kind of model portfolio. Where do you feel as though the asset allocation goes from here into the next 3 quarters?
I think that's really the question is do you de-risk and wait for this to clear up, or you just ride it out, or you put aside some extra cash to take advantage? I think it's somewhat of a combination of that. I'm continuing to like gold and silver. You talked about dividends. To me, the big energy companies, as much as the headwinds are, these are pretty fat dividends, and particularly some of them can handle those dividends. I think it's somewhat of a ride it out, but you need to have some cash as a cushion to look at as dry powder and as some defense, because we don't know how this is going to go from here.
All right. Peter Bookvar, you're sticking around here. Brian, thank you very much for those thoughts. We appreciate it.
Thank you.
All right. Well, coming up on the show, a major energy conference in Houston is now canceled amid the coronavirus outbreak. Add that to the list. This as oil bounces off multi-year lows at this stage. Plus, a look at the worst performing S&P 500 stocks from the month of February. You've got Norton LifeLock, Royal Caribbean, Norwegian Cruise Line, Under Armour. All of those companies maybe have some kind of an effect on the coronavirus. Worldwide Exchange is back right after this.
The question wasn't really, how does Royal Caribbean become digital? But the better question was, how do we give customers back time in their vacation?
Royal Caribbean set a 5-year roadmap that included us first identifying, setting up a digital organization. One of those things was the need to transform the guest experience. EY helped us look at the view of digital from every different angle. We're going to be able to make that experience even better than it is today.
world's newest ocean cruise line is yet again a world's best. Viking's elegant ships deliver a superb, inclusive experience with enriching shore excursions, alternative dining, all-veranda staterooms, Wi-Fi, and much more. We're very proud to have been named a world's best 4 years in a row by Travel + Leisure readers. Learn more at vikingcruises.com.
Sleep this amazing? That's a ZzzQuil Pure Z Sleep. Our liquid has a unique botanical blend, while an optimal melatonin level means no next-day grogginess. ZzzQuil Pure Z's, naturally superior sleep.
Yes, I'm stuck in the middle with you.
No one likes to feel stuck, boxed in, or held back, especially by something like your cloud. It's a problem, but the IBM Cloud is different. It's the most open and secure public cloud for business. It can manage all your apps and data anywhere, so it can help take on anything, from rebooking flights on the fly to restocking shelves on demand, without getting in your way.
Welcome back to Worldwide Exchange, and look at the Dow pre-market gainers so far. Apple, Boeing, and Home Depot all just up around 2 to 3% pre-market. We'll see if those gains hold into the opening bell. Let's bring you up to speed on the global coronavirus outbreak at this stage. Rahel Solomon joins us with the latest headlines and details. Rahel.
Hello again, Dom. So the global death toll from the coronavirus now exceeding 3,000, with a second death reported in the U.S. over the weekend. And New York has now confirmed its first case, a woman who recently traveled to Iran. She was reportedly now isolated inside her Manhattan home. Italy remains the epicenter of the outbreak in Europe, the country announcing that it'll inject more than $3.9 billion into its economy to try to help stem the economic damage from the virus. This will include tax credits for companies that see a drop in revenues, tax cuts, and also extra cash for the health system. And another major business conference now being canceled amid fears of the outbreak. CERAWeek will not take place this month in Houston. Dom, it is one of the world's biggest gatherings of oil ministers and top energy industry execs. But of course, we're seeing now folks are concerned about these large gatherings. So here you see it. Dom, I'll send it back to you.
Travel certainly taking a hit there. Thank you very much, Rahel, for those latest details on coronavirus. Now let's go to Eunice Yoon, who is live in China, where markets rally today on tons of speculation that authorities are going to stimulate the economy there again soon. Eunice, what exactly are we looking to see from the Chinese government?
Well, a whole host of measures. The expectation, as you said, is now that the policymakers here are going to stimulate the economy because the factory activity was just so bad. It was the worst that this country has seen since the global financial crisis. The official PMI for manufacturing dropped to 35.7 when the estimate was for 46. So still a contraction, but much worse than what people had expected. These record low numbers also prompted several brokerages, including ANZ, as well as others, to scale back their estimates for the first quarter. Capital Economics, another research firm, says that they're worried about the employment picture, and they think that the chances of a V-shaped recovery are falling fast. Nomura says that it expects near zero or even negative growth in March because factories will likely not be back online. Now, SocGen said that infrastructure spending is almost certain. Mizuho expects monetary easing by March. Fitch also predicts that China's fiscal deficit is going to jump to 5.9% this year. That would be its largest since 1990 because of all the spending. Now, Chinese authorities are not only spending on a national level, but also locally. In fact, they are offering now more incentives to try to get people to make big ticket purchases, such as Guangdong and Hunan province. Dom, they both have announced that they want people they're offering hundreds of dollars to people so that they could buy their car.
All right, so Eunice, let's talk a little bit about some of the reports that we've seen with regard to economic activity getting back up to speed. We've heard Apple is trying to get its stores back up and running perhaps with limited hours. Starbucks is opening up more of its outlets right now. It seems as though economic activity is really trying to get back up to speed. Just from your thoughts and your observations, are we there? How far are we away from getting China back really up and running?
Well, the government wants China to get up and running, and you do see some more signs of activity. Like you mentioned, some of the shops are opened, some of the factories. I'm hearing when I speak to people who in the factory sector, they're saying that they are getting more people into their factories to be able to produce more products. So it is happening. The pace of it is still a big question mark. We had some encouraging signs because that the epidemic is coming under control. Wuhan, for example, the epicenter of the outbreak, had closed one of its pop-up hospitals because the new infection rate is dropping. And 20 provinces have now lowered their emergency response level. So some encouraging signs, but the pace is still a big question mark.
All right, pace, obviously a big concern right now, but we're showing video right now of some of those hospital beds not as full as they were before. So encouraging signs there. Eunice Yoon live in Beijing with the latest on the coronavirus in China. Thank you very much. On deck for the show, famed investor Leon Cooperman taking on President Trump over his treatment of the Federal Reserve in times of crisis. His comments to CNBC, that's coming up next. But first, as we head out to break, an analyst call we need to tell you about. Apple getting upgraded to outperform over at Oppenheimer. Among a list of factors, the firm cites opportunities offered by the company's strong balance sheet. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. Worldwide Exchange is back in a moment.
A golf course is designed to be difficult, to challenge your thinking and test your execution. But great minds are driven to seek out the complex. They see what others don't, from an angle others won't take. They learn that embracing those challenges is what sets them apart. I am Justin Rose, and we are Morgan Stanley.
Life Room by Four Seasons, where outdoor living meets future technology. No matter your style or budget, Four Seasons has got you covered. Simple shade from the sun? Covered. Outdoor dining and style? Covered. Need additional living space? Oh yeah, that too. Call today and arrange your free design consultation. Four Seasons, we've got you covered.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school.
Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
Coronavirus market impact, medical outlook, global economic coverage. Special reports all day. Go to cnbc.com/coronavirus.
The biggest problem that we're helping address is access to care. Doctor on Demand is available nights, weekends, holidays, on a mobile phone or on a website. So much of the value that telemedicine can bring is empowering patients to seek care when they need it. The opportunity for our overall healthcare system is to deliver all the healthcare virtually that can be delivered virtually. That'll reduce costs, increase quality, and drive satisfaction for the doctors and the patients. This is the future of business. I watch CNBC.
Worldwide Exchange, U.S. markets appear to be clawing back this morning somewhat from last week's massive stock sell-off. Right now, futures indicated Dow higher by about 140 points, the S&P up by about 11, and the Nasdaq up by 56. Longtime market watcher and billionaire investor Leon Cooperman weighing in on that market volatility we've seen as of late. Speaking CNBC last night, Cooperman says he believes the Fed will likely cut rates in response to the coronavirus, but also suggests another course of action as well.
This volatility is scaring the public. It's ultimately going to raise the cost of capital to business. It's going to affect consumer spending, jobs, tax revenues, etc. 50 to 100-point swings up and down in 30-minute time frames make no economic sense. Why don't they reinstate the uptick rule? The president should stop leaning on the Fed. Chairman Powell knows what to do. He's done a very fine job.
All right, uptick rules. President Trump shouldn't bash on the Fed. Let's bring in a few voices into the discussion now. Steve Cheverone is an equity strategist and portfolio manager at Federated Hermes. Brian Kelly is founder and CEO of Brian Kelly Capital, also a CNBC contributor. Peter Bookvar of Bleakley Advisory Group is still with us. He is also a CNBC contributor. Because Brian and Steve are the new guys here to the conversation, Steve, we'll start with you. You heard Leon Cooperman's comments here. The volatility. Is it scaring people? Is it scaring you as an investor?
I think it's scaring people. I don't think I have the luxury of being scared. I'm supposed to be a professional investor. That's why folks bring money to us. So the question is, can you separate some of the fear from some of the probabilities? In our perspective, look, I have no idea what the market's going to do in a couple hours when it opens, and I have no idea what the next 1% move is. Is the S&P worth 10 to 20% less than it was a month ago? I don't think it is. And so then the question becomes, how do you look through it, find opportunities, and put money to work responsibly? And that's what we're trying to do.
So where are you finding those opportunities right now?
So we raised some cash over the back half of last year as markets were kind of hitting highs, so we had some cash to deploy. And then the way we're thinking about it is buying at intervals. We're not looking for events. We're looking for percentages down.
So like large price intervals, not time intervals.
Yeah, it's price intervals. The idea being that, if we are medium to long-term constructive, which we still are, if we like it at 5% down, we like it a little bit better at 10. Large cap growth has been the area that we focused our buying on. We think that part of the market is perceived as a little bit safer. That growth is seen as a little bit more secular. And we like the opportunities there. As we move further down the line, if markets are lower, we'll start to evaluate the value sectors.
All right, so Brian Kelly, let's bring you into this conversation right now.
Yeah.
Is there anything that you've seen over the course of the past week that hasn't scared you? And are you in there buying up the markets right now, given the sharp sell-off that we've seen over the course of the past several days?
So listen, I think there's an opportunity here, if you're going to be nimble and you're going to be a trader, to play for this central bank government stimulus that we're starting to see come in. I think that's what the market's starting to price in, the equity market. It's already happened in the bond market. We're pricing in close to 50 basis point cuts, almost 100 basis points by the end of this year. So that has happened there. The equity market hasn't adjusted to that. And so we have multiple central bank meetings coming up this week. We have an OPEC meeting, which is the Central Bank of Oil, coming up. And then we have the Federal Reserve meeting coming. So I think there's a period of time here while cases in China start to go down. If it looks like it's contained globally, or at least starts to slow down, and you get central bank stimulus, then you have a period of time where you can probably be nimble in this. My concern is the uncertainty. You talked about how everybody is panicking and how everybody's going to Costco and there's a line around the door. If everybody continues to have that mentality and you have Apple stores and Starbucks stores closing down in the U.S., then I don't think this is a time to buy. But frankly, I don't know, and I don't think anybody else does.
I mean, nobody's thinking that Apple and Starbucks stores are fair point. They're going to close in the U.S. at this point. But Peter, Brian brings up an interesting point here. Central banks, the focus of Goldman's note. And we talked about it the last half hour, but it's worth mentioning again. David Kostin, the chief strategist, says that earnings growth in the S&P might be nothing this year. Now you've got John Hatzius and the economics team saying that they expect a half a percentage point rate cut from the Fed at or before a March meeting, the meeting that happens this month. Also an additional 0.5% of cuts in the second quarter, rate cuts from other developed market banks. Should the Fed be acting so aggressively intra-period, if they are going to cut rates, does it send more panic in the markets if they do it before their next meeting?
I believe so. If their next Fed meeting was 6 weeks from now, you can make an argument that they should do it before, but we're talking 2 weeks from Wednesday. So they can't wait for 2 weeks. I mean, we're not in the middle of a financial crisis. We're in the middle of an hysteria more than anything. So do I think a Fed rate cut is going to matter whether it's tomorrow or 2 weeks? It really shouldn't. But, there's an extraordinary amount of peer pressure because earlier in the show you talked about, 10 years we've been medicated on this, and every dip has been bought because the thought of the Fed put, the central bank put. So we've become accustomed to central bankers somehow saving us. But I do want to remind people, remember what happened the last 2 rate cutting cycles.
All right, Brian, you were saying.
Well, I mean, listen, I agree with Peter in that, economically, it doesn't matter whether you get a 50 basis point rate cut today or in 2 weeks, and we can argue whether that would even change the economic picture. But I think psychologically it does. I think psychologically for both investors and for the investing public to have that central bank come in. Now, I'm not a fan of this, but I think just as a pure psychological factor, the sooner that central banks act, the sooner that there's global coordination,
I want my candy today. I don't want to wait till tomorrow.
All right, gentlemen, everybody wants their candy. We've been medicated on it, like you said. Steve, we're going to give the last word to you here. What's your takeaway from this, and what are you doing today?
I think 2 things. Number one, I think there is a role for the central bank here in as far as small businesses. Small businesses that may have demand delayed if folks aren't coming out, they need a tide over. Our play is the following. Yes, earnings growth is going to be lower. The year doesn't end on 12/30, or the world doesn't end on 12/31. There's going to be earnings growth in the years ahead, and we want to buy stocks.
All right, Peter, Steve, Brian, thanks very much for that market coverage. Right now, picks it up on Squawk Box. It begins right now.
Good morning. Another wild ride so far on Wall Street. Dow futures up right now, but they've traveled more than 1,000 points in a volatile overnight session. The U.S. now on high alert as officials report a second death in connection to the coronavirus outbreak and the first confirmed case in New York City. Plus, Goldman Sachs expects the Federal Reserve to get a lot more aggressive, cutting rates by as much as a full point this year. It's Monday, March 2nd, 2020. We're here after the weekend, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernan and Mike Santoli. Andrew is out today. Our guest host for the morning is Liz Young. She is the Director of Market Strategy at BNY Investment Management. It's good to have you here.
Good to be here.
Let's take a look at the U.S. equity futures at this moment. And the key there in that phrase is at this moment. Right now, you're going to see that the Dow futures are indicated up by about 71 points. S&P futures indicated up by 3, the NASDAQ up by 33. But as Joe mentioned, the Dow futures have swung about 1,000 points. A lot of road they've traveled overnight. We're going to be watching this very closely. This comes on the heels of last week's massive declines in the market. The Dow was down by 12.4% for the last week. NASDAQ off by 10.5%. We are watching this very closely. But the Treasury yields are probably the more important story that we're watching this morning, too. So let's take a look at that right now. You're going to see that the 10-year is yielding 1.067%. Mike Santoli, you pointed out the 2-year is the more interesting story to be watching.
In terms of the drama of the move, the 2-year at 0.73 right now, it's been cut in half since Valentine's Day. So essentially, the market has just rushed to price in a tremendous amount of Fed easing in a very short period of time. In fact, I think a lot of the push and pull of futures from when they opened last evening is about, are we going to get some kind of surprise rate cut or some indication? We've had central banks around the world comment on that, but it really has been stunning considering that bond yields were already very, very compressed coming into this weekend, and now we've just stretched to new lows.
I mean, at 1.069%, that still stuns me for the 10-year. We've been watching historic lows set every day since about Wednesday of last week and continuing to watch these numbers drop rapidly. But this is going to be the story that people are watching very closely. Should also point out that stocks in Shanghai surged overnight on speculation that authorities will stimulate the economy soon. As Mike mentioned, there is this talk of a potential for coordinated central bank moves. That's something our guest host on Friday, Kevin Warsh, talked about pretty extensively. That was an op-ed that he put in the Wall Street Journal on Thursday, and it really kicked off some momentum. You can see right now the Nikkei closed up by about 1%. The Hang Seng was up by 0.6%, and then the Shanghai Composite up by 3.15%.
Yeah, Mike, I've told us a million times, we'll get right to the next news, but in the old days, money supply, every Friday, that would come out. So the headline was, stock sell-off as asteroid heads towards the Earth, imminent destruction likely. That was at 10 a.m., but market rallied in the afternoon after the money supply was less than... I mean, the Fed, really, is that going to be what...
Well, I think the context matters a lot.
I understand. We had Warsh on, and he made the case, but really that...
No, I didn't even mean that context.
Oh, okay.
I mean the context where the Dow was down 3,500 points last week. So if we're bouncing a little bit in a very, very overstretched market to the downside, at least because we've already priced in something pretty dramatic in terms of new cases and economic impact and all the rest of it. But I do think that at least in the short term, the idea that the Fed is going to use what ammo it has, perhaps, is enough to at least kind of lubricate the market.
Well, we're disconnecting again between the fixed income and the equity markets. We had that big gap. Maybe it should have, we didn't know how it was going to resolve itself.
Yeah.
Well, it did, with stocks coming down. But now 106, we thought the 10-year had to stabilize before.
That's right.
We thought we'd need a stabilization in the 10-year before the markets recovered. Maybe it doesn't recover today. We're only up 62 points now, but 106. I figured at 115 that it was headed back to 1.25, 1.5.
I mean, even if we get news from the Fed this week that they're going to be more supportive, it's a Band-Aid, right? It's a sentiment Band-Aid. We're going to continue to get bad news out of the economies, both here and abroad. We're going to continue to get revisions in earnings. The Fed can only kind of keep us afloat, and we'll probably chop around. Mike, I know we talked about this last week. We'll probably chop around in a range until that bad news is over.
Right. Here we go. Back to the actual news about the virus. The first case in Manhattan has been confirmed. The patient, a woman who recently traveled to Iran and is currently isolated in her home. Separately, a man in his 70s has died in Washington State. He's the second patient to die from the virus. The first death was reported on Saturday. Both patients who died had other health conditions, and there are now more than 80 confirmed cases so far in the United States.
Let's talk about the impact of the outbreak on the markets after last week's sell-off. $1 trillion in market cap lost by just 6 companies. Take a look at those 6 companies. These are the high flyer